Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hello and welcome to Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me, Mangalam, as well as Rima. Hey guys, good morning.
Good morning. So yesterday was what? A pause for breath?
Yeah.
And today looks like, maybe we'll do a little better than what we did yesterday, at least in the frontline indices. And apart from all of that, everyone's watching out for the Edgbaston test that happens sometime during this week. The good news is that Jasprit Bumrah is likely to play for that test. Yeah. Nigel, waiting for the boys in white?
Well, that's right. Hoping that the boys in white, they come up trumps because they fought hard in the first test and it's a young side, so we bet on them. But, in terms of the market action yesterday, it seemed to be one of those sessions in the, in the 5-day test match where you take a bit of a break, not too bad, catch up on some rest and then move on, I think. So I think the markets will be prepared to move on.
Yes, and we speak about the 5-day test. Again, on day 2 of the test, it looks like a good batting pitch. Why do I say that once again? Because, there was good close on Wall Street yet again. S&P 500 continued to hold on to its record highs. In fact, added a little to that, 0.5% higher, 0.6% higher for the Dow Jones. And the Nasdaq as well ended about 0.5% higher as well. A large part of the gains was largely because, Canada decided to roll back on its digital taxes. The news came yesterday in the market hours for India itself, but the US markets reacted to that. We speak about recovery on the Wall Street. The second quarter that ended yesterday, 11% higher for S&P 500 and 18% higher for the Nasdaq. And add to all of this, the US bond yields actually saw a bit of a dip as well. Why is that? Because one, the street's still awaiting some clarity on Donald Trump's spending bill. And secondly, Goldman Sachs has gone ahead and preponed their first rate cut target from December to September. So all of that has meant that the bond yields saw a slight smidge towards 4.23 as against 4.28 that we saw yesterday, the previous trading session that was. Meta, those shares hit all-time high because Zuckerberg has finally announced his artificial intelligence plan, and it's called the Meta Superintelligence Labs. Remember, they've been, pump priming their entire recruitment desk. They've been hiring from a lot of the competitors, etc., paying as high as $100 million per coder for them to, join them. So let's see what, Meta has on offer when it comes to artificial intelligence. All of that, what does it mean for our markets? The start is likely to be in mild green because yesterday, we saw a decline in the frontline indices. You had the Nifty, Bank and the Nifty. But if you look at the broader markets, Nifty Next 50, the mid-cap index as well as the small-cap index, all of them were very well bid. And typically that happens when the street believes that maybe the frontline indices have very strong support. And that's exactly what is taking place. The good part is some of the excesses from, yesterday, going into trade yesterday, are being taken care of as well. The Nifty has to move beyond yesterday and the previous day's high of anywhere between 25,650 to 25,670, and thereafter we'll move higher. The excess is being taken out. Why do I say that? Because if you look at the India VIX, that continued to decline. Yesterday it seemed like it was, pricing in some sort of complacency. But with yesterday's consolidation, it's moved back above that 12.5 mark. So complacency is getting out of the way. And then we are seeing, some of the excesses, even in the options data, being taken out. I think Nigel will speak a lot more about that. But Rima, the global cues are largely positive.
Indeed, and Asia today is mirroring or mimicking what happened on Wall Street. But just quickly, because it's never a dull day when it comes to Donald Trump, and Donald Trump has once again taken direct aim at the Federal Reserve. In a handwritten open letter to the Fed Chair, Jerome Powell, Trump accused the central bank of acting too late on rate cuts and urged them to slash interest rates by a lot. The letter was confirmed by the White House Press Secretary, Levitt. On Truth Social, Trump went a step further, calling for rates to be at 1% or better and saying the whole board should be ashamed. But that's not all, because here's the latest on the tariff front. While even as the US-India tariffs remain a bit sensitive right now and in a critical stage, in another post, Trump has threatened a fresh tariff level on Japan, citing their refusal to import American rice. They won't take our rice, Trump said, and yet they have a massive rice shortage. He added, we'll just be sending them a letter. Well, all of this as global markets await a critical speech from Jerome Powell. He is expected to speak at the ECB Forum on Central Banking in Sinatra, Portugal. His remarks could offer cues on future rate policy, whether it comes in December or now in September, as Goldman Sachs was saying. Also on the U.S. radar, the Senate continues to debate on the massive $3.3 trillion tax and spend proposal. Remember, the 4th July deadline is looming large. And markets on Thursday will be bracing for the non-farm payroll data for the month of June. But back home, the cues are more immediate. It's the start of a new month, and it's Tuesday, so we'll have the sensex weekly expiry. The auto sales numbers will start trickling in today. We've already started getting business updates from IRDA, HUDCO, and many more will flow through. In fact, I've got about 7 or 8 even IT previews, as the IT earnings will kickstart for the IT majors next week. And also watch for 3 listings today. There is Kalpataru, there is Ellenberry Industrial Gases, and even the much anticipated listing of Raymond Realty today. So it's an action-packed day 1 of 1st of July.
Well, that's right. And overnight the cues look positive, and particularly from an emerging market like India's standpoint, because you have the dollar index that continues to weaken. In fact, it's moved to the lowest we've seen in multiple years. You had Brent crude prices as well that are cooling off, and the 10-year yields as well. That's a perfect recipe, right, from an India market perspective. Well, even in yesterday's trading session, though, the Nifty went home with a cut of around 100 points. A couple of positives out there. One is we ended off the low point of the day, both the Nifty as well as the Nifty Bank. And take a look at the breadth of the market. Many portfolios by the end of trade would have actually been feeling very, very good. And it seems, there was some marginal selling from the FIs, but that's par for the course. There appears yesterday there was more unwinding of long positions, are taking some money off the table post the big run that we've seen. That's why if we look at the Nifty or the Nifty Bank as well, the open interest was lower on both of them in trade yesterday. And that's perfectly reflected what the FIs did. On the long side, they unwound some positions close to 4,000 contracts. They continue to remain net short with 64% of their positions on the short side. And the FIs, they are net short. The clients are net long. But both of them mildly so. In the past, we've seen both of them at 2 different ends. For the time being, they are not very, very excessively net short or not excessively net long as well. So that's how, they're positioned out there. Moving to the PCR, that went dancing away to around 1.25 odd. And we pointed this out yesterday that it's moving towards the higher end of the band. Yesterday, it cooled off to around 0.8. That's one technical indicator you like, because normally the range on the downside has been 0.65 to around 0.7. So now we're closer to the bottom end of the range, which is encouraging. How did that come about? Because we had a lot of call writers, and these call writers seem to be confident yet again. 25,600 call, 25,700 call. Between them, they added close to around 1 lakh shares, and the premium out there 60 to around 100 rupees or thereabouts. Which brings us to the crucial levels you're looking at. Now, we have a bit of a resistance zone, which is at around 25,650 to around 25,750. This is going by the options data. That appears a bit of a resistance level, while the support is the earlier resistance, which was at around 25,250. In fact, the resistance zone perfectly ties in with the high that we saw yesterday. So both on the Nifty as well as the Nifty Bank, you'll want to see the Nifty get past both these 2 levels, because these are the highs that we made in yesterday's trading session. The stock that I'm looking at is Gabriel India. It's had a big run in the last few trading sessions. The street was sensing something. It's up close to around 18%. But they have done some consolidation, with the parent. And in fact, it's EPS positive. They are, going ahead and they're diversifying their product range as well. And it's EPS accretive to quite a large extent as well. Margin accretive, return ratios accretive as well. So on the back of that, I'll keep an eye out on the stock, though it's already seen a big run in the last few trading sessions.
All right, Nigel, thanks a lot for that. So that's about Gabriel India and the market setup for this morning. All cues suggest that it is likely to be a good day of trade for the bulls. Let's welcome Mark Franklin, the Deputy Head of Multi-Asset Solutions Asia at Manulife Investments, joining in. Mark, thank you so much for joining in. Global cues are supportive, though global news are still multi-dimensionary. We get Donald Trump writing to the Fed chair. At the same time, there is no certainty when it comes to trade negotiations. While deal making continues, the stock markets are making a move of their own. So what do you look at, the stock market move or the news?
We have to look at the broader liquidity backdrop, which is generally quite conducive. The Treasury Secretary's policy pivot seems to be the case that they're not going to look to term out the debt, which means there's less pressure compared to previous expectations on long-end bond yields. which then puts less pressure on the cost of capital for equity markets. So all other things being equal, fundamentally, whilst there are some signs of moderating growth in the US economy, the general sentiment backdrop is somewhat constructive, notwithstanding the ongoing and persistent headline risk and uncertainties.
Mark, hi, morning. Let's talk about the Fed rate cuts. When do you expect the first, Fed rate cut? How many this year? And sometimes it's not about when it starts, but where it eventually ends, right? So how many rate cuts do you expect in this particular cycle? Because it's possible that we're not going to go back to those near zero levels that we enjoyed a couple of years back. So what would be the end point of the rate cuts?
There seems to be now about 2.5 rate cuts priced in by the market by the end of this year, and a further 2.5 rate cuts priced for next year. So that takes the terminal rate down to high twos, around 3%. That's not an unreasonable expectation if you believe that core PCE can stabilize around the 2 to 2.5%, because then you have a real yield of about 1%. And that's somewhat of a neutral policy setting. But there's so many things in flux at the moment. And indeed, that market pricing has moved ahead of the dot plot by the Fed officials. So clearly, the market is forming its own opinion in terms of data progression, both on the price and on the growth side. But it's not an unreasonable starting point if the assumption is that tariffs, by and large, won't be quite as inflationary or persistently inflationary as some of the fears being echoed by Chair Powell and other committee members.
All right. Hi, Mark. Good to see you, Ben. What about equities? How do you approach it? I think earlier this year, you were leaning more towards, developed markets. And you said that there could be some kind of move out from the emerging markets. How are you positioned right now? Because both segments of the market are doing well. Some of the emerging markets like India and the US markets as well have seen a big rebound. So what's your take?
There's been a sort of a year of two halves so far this year, up until the early April correction and trough. Rest of world was very much leading US equities. And then since the bottoming out and the rebound, US equities have kind of come back to the fore. And what this is probably telling you is that the market is starting to settle back on those large growth-oriented business models in a moderating growth, moderating inflation dynamic. So a somewhat of a Goldilocks expectation around near-term macroeconomic developments does suggest that barbell approach of having large cap growth, even with the valuations that they offer, alongside the more discounted, higher return potential markets as well. Now, if either the growth data or the inflation data inflects and breaks in an opposite direction, the market will have to recalibrate where it sees the best chance of making returns this year. So let's take two scenarios in turn. The first scenario would be if inflation does start to re-accelerate to the upside, you could see a shift back towards more value-oriented, more discounted cyclical parts of the market, and those business models that give you some kind of inflation protection. And equally, if growth actually accelerates to the downside, you might see a pivot back towards more defensive quality factors.
Right. What kind of probability do you assign to, inflation moving on the upside? Because not only do we have the tariff negotiations which are currently underway, the street believes that may be inflationary. You aren't in that camp. The second part is that there is this big spending bill that will come by as well. So the government spending a lot more, then that could also have inflationary impact, right?
So let's take those two things in turn. With respect to tariffs, no one really knows where tariffs will end up, both in terms of the size of the tariffs and their breadth of coverage. Even if there is a universal 10% tariff that most trading partners with the US accept, they'll equally be pushing for exemptions for certain sectors as well. But equally, some countries will be forced to shift back to the initial tariff rates that the Trump administration proposed in early April if they can't make progress on trade deals. So many uncertainties out there. Our view would be, even if there is a broad-based significant increase in tariffs, that will likely cause a material price impact in the short term and for the first few months. But it's not clear that that price spike will be sustained and will be persistent beyond the first 12 months or so. And then with respect to the fiscal bill that's currently being read in the Senate, the bigger question is, let's say, for example, significant tax cuts for both corporates and certain parts of the population prevail. how will they deploy those tax cuts? If you go back to the first Trump administration and the significant corporate tax cuts, our analysis tells us that a majority of the proceeds from that went into buying back stock. They didn't go into, for example, boosting investment or increasing wages to workers. And so the transmission impact on the real economy was somewhat limited. So that's an example where the devil is really in the detail, the extent to which there is a spending impact, both from the corporate and the household level, from any fiscal tailwinds.
Mark, in terms of global equities now, which are the markets that you like? You're overweight. What would your call be on India, for instance, and even some sectoral themes that you like? Provide some flavor on that.
Yeah, so the way that we're approaching our equities portfolio construction is to have certain expressions which give us a good risk reward. So we're looking for markets that have attractive valuations, high total return potential. I stress total return, both dividends and decent earnings growth as well. So actually markets such as the UK, for example, and to some extent Australia, give you reasonable total return because of the dividend profile and the starting valuations. Then we're looking for secular themes that we think can deliver compound earnings growth for multiple years to come as a result of shifts in geopolitics and geoeconomics. So some of the things that we like, for example, are defense technology, cybersecurity, industrial renaissance, the reshoring of supply chains back to the US. And then with respect to India, one of the things that is a potential catalyst is with inflation being very well behaved, we've now seen the RBI start a cutting cycle, and they moved quite aggressively with their first cut. That gives the Indian economy a chance to try to reflate the cycle, particularly via bank lending growth, which, as we've seen, has been coming down slightly as well. So that creates an interesting narrative of reacceleration, but we really need to watch to see whether demand for credit indeed picks up. And with respect to sort of valuations in India, whilst positioning by foreign investors is not as stretched as it was a few months ago, there wasn't really much of a valuation reset over that period of time. And so the starting potential in terms of re-rating of the multiple is somewhat limited, and therefore it's going to be about the earnings growth story.
So are you overweight India?
It depends on the portfolio, really. I would say that we're broadly fully allocated, neutral against benchmarks. We want to see evidence that the credit loan cycle will pick up as a result of rate cuts. And then as well, there's an opportunity cost angle as well within an Asia context. If you look at markets such as Korea over the last 2 weeks, Hong Kong, China at the start of the year, when you have discounted markets in an Asia region with a positive catalyst, that can really attract investor attention and capital allocation. And sometimes the Indian market serves as a bit of a funding source. So it's as much about whether there are other attractive opportunities within the region sitting alongside India, whether India stands out on its own in terms of an attractive investment case.
Well, Mark, sometimes it's macros before markets, and it seems the Indian macros at least are doing pretty okay. Though the point on valuations is something that could be keeping money away for the time being. But the hope is that we see some foreign inflow flourish at some point of time. So we'll keep an eye out on that aspect. What about other asset classes? Gold, that seems to be going through a melt-up. It's holding around this, $3,200 to around $3,500 an ounce. Any view on that particular asset? Because it's been glittering. It's moved better than a lot of equity shares in the last 18 months or so.
Yeah, it's had a very strong run over the medium term. A couple of reasons for that. One is that you've had very strong central bank buying, not just by the PBOC in China, but other central banks as well, as a means to diversify their US dollar reserves, obviously gold being US dollar denominated, and also as a hedge from an inflation volatility and a geopolitical volatility perspective as well. None of those drivers go away. They just might go through a bit of a pause, and often for good reasons. If inflation is tamed, if geopolitics goes through a period of quiet, which we would all appreciate, then gold may see a bit of profit taking given the strong run as you highlight. But some of those longer term drivers are likely to remain intact. And going back to the point about the US fiscal agenda, if that BBB bill gets passed and it's expansionary from a fiscal deficit perspective, that will create further discounting of the idea that inflation will remain volatile and perhaps at a higher plateau than it prevailed over the previous decade. And gold will benefit from that as effectively as a store of wealth, as a protection against that inflationary pulse. So our longer-term secular view on gold remains positive, but we do think there are reasons why it could see a bit of a pause, some profit taking in the very short term.
So fundamentally, what would be the floor for gold according to you?
We have a fair value model, but it's not a specific pricing point. It typically oscillates with a range. And at current spot prices, we're at the top end of that fair value range. So in that sense, it goes back to my point. You could see a bit of profit taking, but that sort of fair value analysis is really a function of inflation dynamics, real rates, US dollar versus other currencies, and the policy mix as well. And many of those factors are in flux, as we've already talked about.
Right, Mark. Thank you so much for joining in and giving us your perspective on a whole host of things, global news, global cues, global markets, gold as well. With that, we'll take your leave and tell you what are the interactions that we've lined up on the show for you today. Coming up at 8:35, the management of Jupiter Lifeline Hospitals joined in to discuss the impact of Amazon's entry into diagnostic space, also the big demerger that was announced by Apollo Hospitals. So we'll get a lowdown on the healthcare space today with Jupiter Lifeline. We also have at 9 a.m. Sumit Gupta of Centrum to talk about Apollo Hospitals as they hive off their pharmacy digital health business. At 9:20 a.m., Venugopal Mangat of HSBC Mutual Fund will be the market master of the day. Thereafter, we have Nikhil Dhingra of Acme Solar joining in, chatting with us at 9:30 a.m. to talk about multiple order wins in the rare earth magnet supply shortage of the business. A little later, at 9:50, we have Umesh Chaudhary of Titagarh Rail Systems after they've bagged a near 430 crore contract from the Maharashtra Metro Rail Corporation. And at 10 a.m. in our special segment, Indianomics, Lata will get chatting with C.S. Shetty, who's the chairman of the State Bank of India, as the bank celebrates its 70th anniversary.
All right, time to slip into a snappy break. We come back, we'll focus on all the stocks we're tracking for you. Apollo Hospitals, CG Power, Torrent Pharma, Gabriel India, Sona BLW, Precision, all of them will be reacting to positive news flow. And add to the list, IRDA, Hudco, NCC, Prestige Assets. The lone one that's going to be reacting to negative news flow from this list will be NMDC. Slip into that break, we'll tell you why.
Welcome back. Let's now drill it down to the individual stocks you should have on your radar this Tuesday morning. Our research team is standing by with CNBC-TV18's list of top stocks for the day. And first up, once again, it's the pharmaceutical, where Apollo Hospitals is planning a reorganization and some monetization. Ikta joins in with the details.
Hi, thanks for that. Well, yes, Apollo Hospitals is in focus because they will be demerging their pharmacy, digital health and pharma distribution business into a new listed entity, which is NewCo. Now, the transaction involves 3 steps, which is demerger of the omni-channel pharmacy and digital health business, amalgamation of Apollo Health Co., which includes Apollo 24/7 with the new company, and merger of KMed, which is their pharma distribution business, into the new company. So Apollo Hospital shareholders will be receiving 195 shares of the new company for every 100 shares held. The new company listing is expected between 18 to 21 months. Apollo Hospitals will retain 15% stake, and the components in the new company will be Apollo 24/7, which is the digital business, Apollo Pharmacy, which is the retail business, KMed, which is the distribution business, and the telehealth unit. The projected revenue, 16,300 crores in FY25, targeting 25,000 crores by FY27 with 7% EBITDA margins. The structure mainly for Apollo Hospitals removes the holding company discount, and hence it's a positive. Call at 12 p.m. today.
All right, thanks a lot for that, Ekta. And at 9 a.m., we'll be joined by Sumit Gupta of Centrum to talk about Apollo Hospitals as they hive off the pharmacy, digital health business as well. So impact coming up. Well, let's hop across to Nimesh. He's here to tell us about CG Power. He had alerted us, likely to be some fundraise, and bang on. Nimesh, tell us more.
Well, so they've launched the QIP last evening. So CG Power is going to raise 3,000 crores by a very small dilution of close to 3%. The floor price is 660, which means a 2.5-3% discount to the SEBI floor price. So not much big discount as well. I understand there is a very strong demand. 2x book is covered is what I understand from bankers. But interestingly, for the proceeds, the large part of the proceeds will be used for setting up the OSAT facility. Apart from that, they're looking at using some of the funds for the power transformer plant as well as for inorganic opportunities as well. So, but I guess large part is for the OSAT facility, and that's why I guess there is a very strong demand. So 2x demand is what I understand, and a very small discount as well. So maybe I'll go with the green because of the fundraising. Dilution is quite small at just 3%.
All right, Nimesh, thanks a lot for that. Let's go back to Ekta. Ekta's got a busy morning. Torrent Pharma, the big deal that was announced yesterday. Ekta, you heard into the conference call. What were the takeaways?
Well, yes, important takeaways where they have said that the first year of the merged entity, with which is JB Chemical and Torrent Pharma, should be EPS accretive. Leverage ratios look comfortable to them. They would be around below 0.5 times 2 years post the deal. When it comes to debt, we'll see if equity is required to fund the deal at all. So it's not something which is definitely on the table. They expect procurement savings, combined manufacturing to result in some amount of savings. Timeline to complete the transaction is anywhere between 15 to 18 months. Valuations have softened versus last year, which now made the deal attractive. So overall, they seem to be quite positive when it comes to the merged entity being EPS accretive, as well as the fact that leverage shouldn't be too much of a concern.
Got it. All right, Ekta. Thanks a lot for that. So all positive news flow this morning, barring NMDC, which I'm tracking. They've gone ahead and they've cut prices effective today by 600 and 500 rupees on lumps as well as fines. And the revised prices come up for you on the screen. Remember, the past month as well, they had gone ahead and cut prices by around 140 to around 150 rupees per ton. So given that it's the monsoon season, we normally see a price cut. And the stock as well, the performance gets a little bit subdued in the monsoon season. However, this price cut of 600 and 500 rupees is actually larger than what most on the street were working with. But why are they cutting prices? Remember, Chinese demand has been a little bit softish, which has caused iron ore prices to correct. Supply as well has picked up out there. That's on the global front. And domestically, since it's the monsoon, a lot of smaller mills will be shutting down, which creates some excesses of iron ore in the system. So softer demand from steel companies is the other reason out there. Expect the stock to react in the red. But Hormuz is joining in. He's tracking a couple of companies. Gabriel India, that could be one of the stocks of the day. And Sona BLW. Hormuz, take it away.
Morning, Nigel. And a couple of developments, as you mentioned, for Gabriel as well. And the price action was indicating that something was in the offing because the stock was up 20% in the last 5 trading sessions. And last evening, they have announced the fact that they are going to consolidate the Anand Group's auto businesses into one single entity. And this will be done through multiple steps. Now, the first step will involve the merger of Anchemco into Asia Investments Private Limited. And then the Asia Automotive Businesses of Asia Investments, or AIPA, will first be demerged and then merged into Gabriel India, and because AIPA has other non-automotive investments as well. Now, as per this deal, Gabriel will be offering 1158 shares of the company for every 1,000 shares of AIPA that people have as of the record date, and as a result of which the promoter shareholding will increase to 63.5% from 55% after this merger exercise is complete, done at a multiple of 8 times EV to EBITDA, and they're expecting some more value unlocking to take place because of this and consolidation of the group's shareholding structure as well. So expect a positive reaction there. Sona BLW, well, they told CNBC-TV18 last evening that they are considering manufacturing of rare earth magnets in India, and they are waiting for the government to roll out an incentive scheme in this regard, and the final decision will be taken based on the incentives that are offered in that scheme, and they are likely to apply for any such scheme in case that gets rolled out as well. Of course, rare earths are used in a lot of other automotive components as well, so it will be a positive in case such a scheme is rolled out. So keep an eye out on Sona BLW as well.
All right, we take that point. Near-term positive for Gabriel, a long-term positive for Sona BLW. We'll keep an eye out on these stocks, but a bunch of other stocks also making news this morning. We have Vamakshi joining in with that list. Vamakshi, good morning.
Good morning, Mangalam. Let me first start off with IRDA. The company reported its business update for the quarter gone by, that is the first quarter FY26. Loan sanctions stood at 11,740 crore. This is a very strong uptick of almost 28.5%. The loan disbursements were up almost 32%, 31.1% on a year-on-year basis. basis at almost 6,981 crores, and the loan book also resultantly saw an uptick of almost 26.5%. As far as HUDCO is concerned, going with the green for this counter because the loan sanction saw a substantial jump to 33,904 crores. This is a 140% uptick on a year-on-year basis, but the loans dispersed were up only 1.5% at 12,812 crores. But when we look at this on a sequential basis, it's a very good growth. So therefore, going with the green for this counter. The next stock on our radar is NCC. The company's building division has received orders worth 1,690 crores in the month of June, and these orders have been received from state governments, some private limited companies, and include no internal orders. Bodes well for the company. Green for NCC. Lastly, keep an eye out on Prestige Estates as well. Green for this counter because they've launched a residential project which is Prestige Pallavaram Gardens in Chennai. This project has a GDV of almost 3,350 crores, and this is the third launch announced by the company after Bangalore, which was a plotted development, as well as Indirapuram launch.
Thank you very much for that, Vamakshi. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Apollo Hospitals, CG Power, Torrent Pharma, Gabriel India, Sona BLW Precision, IRDA, HUDCO, NCC, Prestige Estates. Well, the only stock which could open in the red today is NMTC. But moving on now to what's happening in the world of commodities, currency. Manisha is now joining in with a complete roundup. Manisha.
Thank you for that, Reema. I'll start with the crude oil prices, where we've seen 2 months of gains coming for the commodity, while, of course, today is yet another day that you're looking at a 0.5% decline right now. And that is because the markets believe that OPEC Plus will increase supplies by 400,000 barrels per day for the month of August as well. This would be a fifth month of output increase, and that would bring the supplies higher by 1.78 million barrels per day. What is weighing onto the markets? But barring energy, everything else seems to be doing quite well. Gold gained 1% overnight. Silver was up 1.5% as well. Tin gained to 3-month highs. The recovery of trade flows in China, US and China working toward trade agreement are supportive factors for many of the metals. And add to that the fact that we've seen some economic data come in positive, and then China is talking about more stimulus measures as well. So other metals like aluminum, copper also are trading at a 3-month highs. Add to it the fact that you are also looking at supply and inventory concerns. That has been supportive. Even lead prices are trading at a 13-week highs. So multi-week, multi-month highs for many of these metal prices in Asia.
All right, metal prices rising. We've seen the weakening of dollar index as well. So that has a positive impact on some of these commodity prices. Manisha, thank you so much for joining in. Take a short break. On the other side, we have the management of Jupiter Lifeline Hospitals joining in to discuss the impact of Amazon's entry into the diagnostic space, the entire healthcare space. We'll also get Amnish Agarwal of PL Capital join in. Welcome back. You're watching us here on Bazaar Morning Call. A positive start is what the GIFT Nifty is indicating. Yesterday was a pause for breath for the frontline indices. The broader markets did a lot better. But one stock from the frontline pack actually surged in the last hour of trade, and that was Trent. After a big gash from the highs, some brokerages, looking at it positively from a valuation standpoint. Amnish Agarwal, the Director, Institutional Equities at PL Capital, joins in now. Amnish, good morning. For Trent, what camp are you in? Valuations are now getting supportive after the cut, or do you think they still have some loopholes that they need to plug before the stock goes back to its all-time high? I think you're on mute, Amnish. If you could unmute yourself.
Is it fine now?
Yes, perfect. Go ahead.
So Mangalam, it's very difficult for me to say your stock going to 52-week high or something, but definitely Trent has got, I would say, relatively unique business model in the apparel space. Because they, first of all, they are not competing online for Zudio, and even for their, you can say, the main brand, which is Westside, they are not selling on the other portals. And what they're offering to the consumer is a lot of value in terms of designing, in terms of quality at a certain price. Now, recently, during the analyst interaction also, the company has indicated that its aspiration is to grow at 25%. Now, if you grow at, say, 25% CAGR, I think some bit of, say, operating leverage will also come through, and which will make it one of the fastest growing companies in the consumer stock retail space. Now, if I compare trend to some of the other names in the consumption space, which might be trading at 50 times, 60 times earnings, so I think the longevity of growth as well as the visibility in trend remains better than many of the other names. Regarding the valuations, I would say, for example, if I look at, say, Trent, and if I look at, say, a stock like, say, DMart, there is very little gap to choose from. But it is the business model which makes Trent slightly superior in comparison to some of the other names in the retail space.
You know, just to extend that argument, if you're looking at Trent's growth pathway and you're looking at the overall addressable market, one stock that can be compared in that regard is Nykaa, because again, it's consumer discretionary. Trent has called out beauty and fashion as one of the growth paths for the company, as has Nykaa. If you compare the two, and over the last 3 quarters or 4 quarters, even Nykaa has outperformed the industry by quite a multiple. Would you look at these two? And in the last 3 months or so, the response in terms of shareholder returns has been identical, 16% higher on both Nykaa and Trent. Would you compare the two?
You see, I think they are not comparable because Nykaa they're trying to be omni-channel, but it is predominantly an e-com and you can say e-com-led model. That is one. Secondly, in terms of profitability, there's a sea of difference between the two. For example, you look at, say, Nykaa. So I would say very, very little profitability is there. So even if, say, I look at Trend today, maybe it might be 70 times plus 2 year forward. But can I have that kind of number for Nykaa? Very difficult for me to say, because the gap in terms of, say, few years back, Nykaa used to be a very unique business model, but today you have got Myntra, who is trying to, you can say, do the same. Okay, even if I don't consider, say, Amazon in the same league, tomorrow you can say, you see the differences today, practically everyone, say, a couple of days back, even Blinkit had you can say, a beauty day, okay, where there were some, maybe, I don't know exactly how many, 40 brands, 30 brands, whatever they might be. So they were also, you can say, giving a lot of discounts and promoting that. So every big e-com player ranging from, say, a big basket, so they are having a beauty, you can say, stack, which is now separate. So that actually reduces the uniqueness which a Nykaa had, say, a few years back, and that is also getting reflected in the fact that your profitability today is not keeping pace with the top line growth.
Hi, morning. Do you look at Apollo Hospitals at PL? And what have you all made of this planned strategic reorganization of the business, the pharmacy, digital business, all coming together and the eventual listing? And it's big numbers, right? 25,000 crore of a top line by FY27, 7% EBITDA margins. What are your thoughts on this move?
You see, Apollo as a company, we have been liking this stock, and one of the big drags for Apollo Hospitals in the past has been the fact that they have been losing money in 24/7. So they were earlier also clear-cut, you can say, guidelines as to by when the company will look at you can say, full turnaround. But I think this demerger actually will be a win-win for all the shareholders, because first of all, you will get to, you can say, get a place separately in the pharmacy retail, which is again a very thriving, very growing area where many of the conventional retailers they are also planning to enter. That is one. And secondly, it also reduces burden on the balance sheet as well as the P&L of Apollo Hospitals. So I think from that standpoint, I think very difficult to say whether it will result in any sharp run-up in the immediate term, but in the medium to long term, I think the Apollo Hospital continues to be one of the best hospital stocks.
Got that. Amnish, request you to stay on. We've got the management of Jupiter Lifeline now joining in. The story that we wanted to talk to them about is Amazon's entry into the diagnostic space. Will it impact their business, and how is business for them? The key trends going ahead. Ankit Thakkar, ED and CEO at the company, is now joining in. Ankit, thank you very much for joining in. This is Reema here. So at the hospital, I presume you would have your own in-house diagnostic business, right? So do you see Amazon's entry increasing competition for hospital-based labs like yours?
Hi, good morning. So I think for hospital labs, it is predominantly captive usage. That is, the lab predominantly works for the outpatient seen within the hospital and the patients admitted within the hospital. I don't think any of the hospital labs really rely too much on community footfall. So in that sense, I don't think that Amazon entry should make too much of an impact on hospital lab business.
Okay. Amazon is also targeting some of those high volume routine tests. Any idea on the kind of pricing versus what's available in the market? And I understand that for y'all, the diagnostic business is mainly for captive in-house patients. But would you look at any sort of a collaboration? Is there an opportunity in a partnership where perhaps your hospital acts as a node for Amazon?
So it's still early days. I don't think they have divulged too much about what their pricing or business model is really going to be. As far as we are concerned, I don't think, right away without knowing what they want to do, I could really comment on partnerships as such. Whether they want to, like a marketplace, essentially just aggregate orders, or do they want to run labs themselves? So I think early days, let us look at what they want to do.
Right. Ankit, I wanted your thoughts on your own digital business and your other verticals, also in light of what took place overnight with Apollo Hospitals demerging and trying to unlock value in some of their ancillary businesses, ex of their core hospital business. Do you have any? If you could give us a sense of what proportion of your overall revenue do they account for? And if at all, you would be looking at this now as a serious value driver for shareholders?
So at Jupiter, we are currently quite clear. We don't want to try and do this diagnostic or pharma spin-offs. We think we want to continue focusing on the healthcare business. We understand tertiary care, comprehensive health facilities well, and we want to continue doing that for the time being. We have no mood at this moment to spin off any of the ancillary businesses.
All right. Hi, Ankit. Good morning. Good to see you. We're Nigel on this side. Let's get a few details out of the way. You have a big, ambitious plan to add a lot of capacity. So tell us, what is the updated capacity as of now? Where did you head it? And if you could tell us phase-wise, how does that take place?
Hi, Nigel. So we are currently running 3 hospitals, capacity of around 1,200 beds. We are looking to double it up over the next 3 to 4 years. Next year, our first new greenfield in Dombivli, Palava comes up, 500-bed facility. A year and a half or so after that, we will start a 500-bedder in Pune. And we have just added one more land in the MMR region in Mira Bhayandar, where we will do 300 more beds. So we are looking at doubling up to 2,500 beds, all greenfield, in the next 3-4 years.
Got it. All right. So, and I think most of that will be funded via internal accruals and via the cash in books?
Absolutely.
All right. Let's talk about the near term then for FY26. What kind of guidance can you give us on the average revenue per bed, on the occupancy? And if you could tell us, even on margins, what is the broad guidance?
So broadly speaking, of all the 3 hospitals, if I break it down for you to make it easier to understand, Thane, I think, is a matured hospital. The ARPOB should grow in line with inflation. In Pune, we still have a little headroom for growth in terms of occupancy. We are in mid 60%. So I think we can go to 70 plus in occupancy over there and add that to the ARPOB increase. And in Indore, of course, we just added 80 new beds in this year. Those will get occupied. We have a pricing rise coming up as well, followed by case mix optimization, which Indore will continue to see for a year or 2 more. So those are the 3 levers which Indore enjoys.
Are you looking at any inorganic plans? Because yesterday we did have Rainbow Hospitals increase their bed capacity in Hyderabad. They did say that they're looking at, some other geographies as well, maybe closing a couple of deals from here on. Do you have any sites in mind which you believe can, increase the pace of your room addition?
So for the time being, we are committed to Western India. We are committed to predominantly greenfield-based growth. We like this because we think we can control the location, we can control the infrastructure, team cultures, etc. We have understood this model very well. This continues to be our focus area. However, along the way, if some interesting acquisition opportunity does come up, which makes sense, we are open to look at it. But
Nothing at the moment, right?
no, nothing at the moment.
What about international patients? Some of your peers are talking about some weakness in the international patient sales. Is that true?
We have never had an international focus, and our international revenue is negligible. We predominantly have a local community-based business model where we say that each of our hospital should be a nodal flagship hospital for the local community residing 30 to 40 minutes away from us. So for as far as we are concerned, no major impact on international.
And how has the payer mix evolved for you? How much accounts from insurance? And how does that change your average revenue per occupied bed?
So predominantly today, more than half, 55% of the revenue is accounted for by the insurance segment. It is growing year on year. And that really helps in terms of, demand utilization. Because it really takes affordability out of the equation for most of the community. So we see a growth in insurance as a payer every year.
So basis your normalized growth, how much faster do you think the insurance payer grows? What's your target ratio here?
So we don't have a target. We are agnostic of whether the walk-in patient wants to pay out of pocket or through an insurance. We are just kind of witness to the changing scenario of the insurance landscape. Over the last couple of years, there has been a significant uptake. And from what we see, I think retail insurance and group insurance both should increase significantly over the next 5-year period.
Ankit, thank you very much for joining us this morning. We need to slip into a very short break. On the other side, we'll get chatting about market technicals. We'll invite Sudarshan Sukhani and Mitesh Thakkar and prep you up for today's trading session.
Welcome back. Hope you're having a pleasant morning. For starters, the GIFT Nifty was suggesting some kind of green, I think so, the last time I checked. Let's see if that's still holding out. Yeah, a 20-point pullback is what we're likely to see after a bit of an off day yesterday. That said, let's get in our technical experts. Sudarshan Sukhani and Mitesh Thakkar are back with us on the show. Good morning, gentlemen. Thanks a lot for joining in. Sudarshan, what's your take? The markets paused for breath yesterday. Appears the trend is still up. How would you trade the Nifty?
Yeah, good morning. See, the markets are likely to remain range-bound. We had a very big up move. After a big expansion, markets normally take some rest. As you said, just have a breather, then maybe chop around till they decide on the next course of action. I would assume that the next course of action, whenever it comes about, would be again on the upside. But for the next few days, the markets could simply be choppy. Yesterday was a very narrow range day. Today, I would assume that the range will expand. So in an expanded range environment, likely environment, there is a trade available. Look for a sharp intraday correction. If you get that correction, buy that correction. So that's the trade for today.
All right, so buy corrections. Mitesh, would you concur with that view, or would you buy at the open itself, a 20-point uptick after a 120-point downtick that we saw yesterday?
So, yesterday my view was to take profits as we get closer to about 24,700, 750 zones. I think one, there's a falling gap over there. Two, I think the intraday charts are extremely overbought. So I would also want to buy into a decline. I would even suggest that if you get closer to 24,750, 720 zones, I think take profits and reduce a long exposure. I think a good entry point will happen close to about 25,350 to about 25,400 with a 100-point kind of a stop. And on the upside, 25,700, 750 till it's crossed, I think, and in the short term looks like will be a very, very formidable level to get past.
Looks like both of you all would want to buy the dip closer to 25,400, 25,350 to 25,400. Individual stocks, Sudarshan, yesterday you had an all-buy list. Does that continue today as well?
Yeah, that continues. The trend is still up. Ramco Cement is a buy with a stop under 1055. Coromandel, which keeps on coming now in my list, is again a buying opportunity, stop under 2440. UPL is a buy, and we'll just see how it goes with a stop under 647. And JSL is a buying opportunity with a stop under 694. So they are all mid caps with just one theme: look for dips and buy.
Okay, got it. Thanks for that, Sudarshan. Mitesh, what about you? What's in your radar?
So I have two stocks which are common with Sudarshan. In fact, UPL features on my list as well for a target of 680, and Coromandel is a buy with a stop below 2460 for targets of 2600. That apart, SRF is a buy with a stop at 3200 for targets of 3330, and TCS is a buy, keep a stop below 3440, and look for a target of around 3505.
All right, gentlemen, thank you so much for joining in and giving us your early morning setup. We'll come back to you just pre-open, and thereafter we'll also get your trades at 10. Take a short break. On the other side, we have the market pre-open rates, and Sumit Gupta of Centrum will join in to talk about the Apollo Hospitals demerger as they hive off their pharmacy, digital and health businesses. All right, less than 20 minutes to go for market to open. The GIFT Nifty indicating a slightly positive start. We have 5 minutes to go for pre-open as well. Let's take a look at a bunch of stocks which are on our radar. Ever since the big deal that was announced where JSW Paints went ahead and acquired AkzoNobel, the paint stocks have been doing well. And we here on CNBC-TV18 did tell you that, the situation seems ripe for some of these paint stocks because one, competition is now more familiar than what it was earlier. Secondly, demand environment is improving. Thirdly, the raw material environment also is a lot better. And these stocks have seen a correction from the highs already. And that's something, as a sentiment which is coming from brokerages this morning as well. ICICI Securities, the one that actually downgraded the paint sector for the first time 4 years ago, has now revised its stance. They've upgraded Asian Paints and Berger from reduce to add. And they've revised this negative stance of 4 years, because they believe that the fight for number 3 player continues with Birla Opus and Akzo JSW combined, with the first 2 players remaining as they are. And this is something that was said by Abhijit Roy of Berger on CNBC TV18 on Friday as well. What is their rationale for upgrade? They've looked at data for the last 20 years and they believe after every 2 weak years, the third year, there is an improvement in demand. So demand looks a lot better right now. Secondly, Birla Opus has exhausted nearly 95% of their allocated budget for paints business, so which implies that any more investments that they will make would perhaps be economic value added or EVA negative for them. EBITDA margin for paint industries is near bottom end of the guided range because they believe that going forward, contained crude prices will improve EBITDA margins, and improved product mix will also do well for the existing paint companies. And for all of this, the valuation multiples for both Asian Paints and Berger are now at one standard deviation below the average valuations at which these companies would trade. So things are turning favorable. What have they done with their target price? Asian Paints, while the stance has been upgraded, the target price too revised from 2,000 to 2,700. Berger Paints as well, target price improved from 515 to about 650. That's about the paint space now. Amnish Agarwal is still with us. Amnish, you joined us when this deal was announced, but from now, post everything that has come by, what are your thoughts? That's point number one. And today, we also have, JSW Paints and AkzoNobel jointly addressing the press. What is it that you would be looking forward to from them?
Mangalam, can you repeat your first question?
The first question is your thoughts on the paint industry.
Okay, you see, there is as of now no change in our view on the paint stocks. Because, you see, demand, we are also experiencing that the demand should be better this year around. Okay, but will it result in any significant increase in the profitability growth is something which we need to watch out for. Because the competitive intensity has increased, the realizations, they remain on the negative side. Yes, there is some cushion which will come for the paint companies because of the benign crude prices. but how much they can hold on to, only time will tell. So we believe that still the valuations are not that cheap. Say for Asian Paints, it might be trading at say 45, 47 times on FY27, unless and until we are factoring in very sharp jump in profitability, which looks slightly difficult to us as of now. Now, as far as your Exo and JSW is concerned, so I believe that it is not something which is a very, you can say, normal kind of a scenario that now the four players have established, because JSW has always been very aggressive, and you can actually check the filings, how many times they have gone to the regulator that our distribution is being hampered. There are a lot of, you can say, monopolistic policies which are followed by the market leader. Now, what they lacked was a clearly visible brand on the ground. And what Exo brings to the table is, I would say, a great brand, but not so aggressive, and I would say very limited work done on the ground. Now, if you combine both these factors, the aggression of JSW plus the brand quality and technology which Exo possesses, I think that actually, you can say, is a good combination. And while one can say that the current market share might be 10%, so the way JSW Group has expanded in some of the other segments, I don't think that the number 3 player eventually will be having only 10% market share 2 or 3 years down the line. So I think the war among all these 4 paint companies is only going to intensify from here as we go along. And that is going to, you can say, check any significant increase in the margin from here. Yes, many paint companies, one might believe they are near the bottom in terms of the valuations, but I think it is early days as yet.
Okay. By the way, today the auto sales numbers for the month of June will start trickling in, and just quickly run our viewers through what's expected this time. Well, in a nutshell, two-wheelers are likely to perform better thanks to stronger domestic demand, some export recovery. Tractors should also see a fairly healthy uptick. There are some signs that rural market is beginning to bounce back, but it's the passenger vehicles which is losing some steam. Demand remains soft. Inventory correction has also weighed on volumes. So these are some of the numbers that CNBC-TV18 has put out. So for passenger vehicles, on an aggregate, sales should be down about 5%. Two-wheeler sales up 3%, tractors up 6%. MHCV should be under pressure, but that's largely on account of Tata Motors underperforming. Now, in two-wheelers, it's Bajaj Auto, Hero MotoCorp with about a 6% growth. The standout is going to be TVS Motors, 23%, and Royal Enfield should also be pretty strong, 17%. Now, passenger vehicles, as we said, is going to be, is going through a challenging period. So for Maruti Suzuki, Hyundai, and Tata Motors, sales are likely to decline in the month of June. M&M Auto is likely to buck the trend, and here sales are very strong thanks to all the launches that they've had. Sales are seen up close to about 13%. In the CV space, Ashok Leyland is up about 3%, Tractor Numbers 7%, Escorts is up close to about 4%. So two-wheelers, okay, passenger vehicles under pressure. Even the Vahan retail data seem to suggest that, while commercial vehicles should also be fairly all right. Amnish, let the numbers come in and then we'll discuss the auto sales. But there's also that news about ABS, that's the anti-braking system being potentially mandatory for two-wheelers from 1st of January. The government has released a draft notification, so it's not yet a rule. But if it comes through, it will hurt particularly some of the lower-priced two-wheelers. So say a Hero MotoCorp could be impacted more, and we saw the stock correct. What are you all thinking about this issue at PL?
You see, whenever the regulation comes in the auto industry, whether these are emission norms or whether these are, you can say, having these safety norms implemented, it eventually results in an increase in the price of the vehicles, whether two-wheeler or the four-wheeler. Now, the main thing is when you look at, say, two-wheelers in particular, the sensitivity to any such changes is much higher, and that too more at the entry-level segment. Now, once that gets implemented, definitely the companies are going to pass on a major part of the cost increase to the consumers. And this, you can say, a few thousand rupees increase for a big part of the industry volumes. I think it has got the potential to, you can say, depress the volumes at least in the near to medium term.
All right. Talking about monthly updates, I think some of these pipe makers have started giving in their numbers, and APL Apollo will be the big one to track. But I think I saw the bottom of your screen, there was JTL Industries as well that have actually delivered pretty good set of volume numbers. Remember last year, it was lower than what the street was working with. But at least, that first tick that I saw, and as per the press release, they've delivered a 26.5% growth in volumes for the first quarter. And even if you compare the first quarter with the fourth quarter of last year, that as well is up by close to 32%. It has some valuation comfort, but otherwise it didn't really perform in FY25 in comparison to the guidance that was given earlier, though this is a good start to the year. Amnish, any view on these pipe makers? Some of them have done well. They're still a far cry away from all, those 52-week highs. Even the leader, APL Apollo, in the last 2 years has made no money. What's your view on this space?
You see, if you look at the order books, if you look at the overall demand in the economy for all these pipe players, that remains quite strong. Okay, so that is one part of it. So in terms of growth, I think that there doesn't seem to be an issue. However, if you look at, say, the past 3-4 years, all these stocks and APL Apollo in particular, they have seen massive re-rating. And what usually happens is that in all these stocks, when your re-rating then stops at a certain point of time and the P multiples go high, then there is usually a period of, say, sometimes even 1 or 2 years when the stocks go sideways. And I think that is typically what is happening with all these, you can say, APL Apollo and many of these pipe companies. So while the numbers I believe that the numbers will continue to, you can say, come in, the infrastructure, real estate, all these, you can say, construction linked and all these sectors are doing well. So I don't see an issue as far as your growth is concerned, but I think the incremental PE re-rating looks difficult. And that can result in much more consolidation in the stock price before they again start making a move.
Amish, hold on. The Reserve Bank of India, this is just another issue that we wanted to talk about. Reserve Bank of India has released the financial stability report saying that the Indian financial system remains resilient with healthy balance sheet amid elevated global uncertainties. Bad loans are expected to stay near multi-decade lows, and banks have adequate capital buffers even under adverse stress scenarios. Lata's here with the details. Lata.
Well, a way to summarize the report is that it's global risks but domestic bliss. Globally, of course, the report points out things we already know. Both financial markets and the global economy are bedeviled by policy uncertainty, especially trade policy uncertainty. Financial markets, especially bond markets, are volatile, and that's because of the overhang, the over-indebtedness, over-leverage of governments, whether it is the US, Europe, China, all of them, huge public debt. Given these circumstances, if there is a shock, it will be amplified, is what the report says. But in this context, the Indian economy is clearly a beacon of both growth and resilience. It's contributing very highly to the global growth, with 6.5% forecast for the current year and a 6.5% last year. But it is also underpinned by strong macros, whether you look at inflation or current account deficit or the falling fiscal deficit. But the financial stability report concentrates on financial institutions. So coming to banks, NBFCs and corporates, all of them are showing clean balance sheets. They point out mutual funds and clearing corporations, also the stress tests validate that they can withstand a decent amount of stress. The insurance regulator points out that consolidated solvency ratio of the insurance sector remains above the global minimum threshold limits. But like I told you, the financial institutions and banks are treated with more intensity. So the report over here is the gross NPAs and net NPAs, bad loans of banks, are at multi-decadal, maybe even all-time lows. It's March 2025, it was at 2.3%, and net NPAs was at 0.7%. Then the Reserve Bank puts stress scenarios. How do they do on stress? In the baseline, the gross NPAs are going to rise. Now, this is very important, okay? We are seeing the best as of March 2025. Baseline, it will go to 2.5. Not a big deal, 20 basis points more because of growth. And then the capital adequacy in March 27, again, is going to be a little less. 17.2 at the moment. 17 is a damn good number, but it's less. And CET is common equity, the equity shareholding, that will go up from 14.6 to 15.2 because of the huge retained profits of banks. Then you come to the stressed scenarios. In the stressed scenarios, The adverse scenario, the GNPA will rise to 5.6. Slightly less scenario, it will rise to 5.2. But usually these don't materialize. You know, the Reserve Bank just does this as a matter of exercise. The capital adequacy again will fall to 14.2 and 14.6. Common equity also falls a bit under highly stressed scenarios. NBFCs, okay, I forgot to mention one thing. The very important point is that credit growth has not done well. For banks, it has fallen to 11% as of March, and as of June, where the number is available, it has fallen to 9.5%. So that's not a good thing. Coming to NBFCs, again, the gross NPAs of NBFCs are all-time lows. They stand at 2.9%, but here again, as a baseline by 26, they are going to rise to 3.3. So let's remember that the best is past, but 3.3 is not a difficult number at all. Capital adequacy again will dip a little by March 2026. The NBFCs also showed weakened credit growth, especially in the unsecured loans, and MFI loans actually contracted. So in both banks and NBFCs, growth is an issue. Asset quality superb. Just one more point: the savings of Indian households has largely been spent on debt. 55% of the debt taken is for consumption. Only 29% is to build homes. That may be a matter of bit of regret.
All right, we will take that point, Lata. Thank you so much for that. Global uncertainty, but domestic bliss, and that's reflecting in the prices as well. The Nifty Bank at a record high. But what's the standout brokerage of the day? Nimesh joins in with what he's highlighting from a swathe of reports that have come this morning. Nimesh.
Hi, Mangalam, sir. Today's standout is an IDFC First Bank. Investec has put out a note. They've upgraded the stock to a buy from hold, and they've raised the target price to 90 rupees on IDFC First Bank. They see that IDFC First Bank should deliver a 29% core PPOP CAGR over FY25, FY28 estimate, and aided by 80 basis point reduction in the cost to asset. They also see a combination of 90 basis point decline in the credit cost, which would mean that the ROA can drive up to 1.3% by FY28 estimate versus just 0.5% in FY25. Again, the big concern has been the cost to asset. That's likely to decline from year on. And they also expect a fast rationalizations in terms of both assets as well as liabilities, which is coming to a completion according to that Investec note. And they believe that the EPS growth story is quite compelling, and hence an upgrade to a buy now with a target price raised to 90 rupees on IDFC First Bank.
Thank you very much for that. Sudarshan is back with us for his 9:10 call.
Yes, it's UPL. Buy UPL with a stop under 647.
Mitesh?
I'll go with a buy on SRF for targets of 33.30, 33.40.
Okay. Let's just quickly run through Bajaj Auto's June sales numbers. Now, total sales have come in at 3.6 lakh units. Now, this is just a growth of 1%, lower than the CNBC-TV18 poll of 3%. Also, 3.6 lakh units is much lower than what they did in the prior month of May, which was 3.84. So year on year, it's a growth of just 1%, lower than expectations. And month on month too, we've seen the sales slide. The problem is the domestic sales. Now, domestic sales in the month of June have fallen by 13%. And in the first quarter of this year, year to date, April, May, June, domestic sales are down close to about 8%. Exports continues to fire in line with what the company had been guiding. So when we spoke to them post Q4, they indicated that on a quarterly basis, exports should grow by 15 to 20%. And in the first quarter, exports are tracking a volume growth of 16%. So exports are fine. But I think the miss compared to the expectations has come in on the domestic sales, which have declined by 13% on a year-on-year basis, resulting in the overall sales growth being very muted at 1%. And I think the management had also spoken about the domestic industry seeing a growth of 5 to 6%. So compared to that, at least, Bajaj Auto is tracking much, much lower. We'll wait to see how the stock opens. In pre-opening, it's on the flatter side.
Yep. And, that's similar to what Escorts Kubota also reported while Bajaj Auto numbers were flashing on the screen. Escorts actually saw domestic growth of just about decline. It was just flat. 11,000 was same time last year, and this time around it's 10,997. The growth has been led by exports. which on a very low base have increased from 234 tractors to 501. But let's get in Hormaz. He is tracking Dixon and OneSource. Why is that, Hormaz?
Morgan Stanley has downgraded Dixon, and they're one of the bears on the street on the stock. They've downgraded it to an underweight from an equal weight. The target is raised to 11,563 from 8,696 earlier. Now, 8,696 was the lowest target that Dixon had on the street, and despite the price target revision, it still implies a 23% downside. And they are seeing high competition in their core EMS business, expecting earnings to slow down between FY27 and 30. Now, they're saying that the components manufacturing is a step in the right direction, but it could be tougher to execute in compared to the EMS business. And although they have raised their revenue estimates by 15 and 52% for this year and the next one, they still remain bearish on the stock. On the flip side, DAM Capital has initiated on OneSource, and that is a positive rating, buy recommendation, a 25.29 price target, saying that it is a perfect proxy to play the volume expansion in the generic GLP-1 segment, and these higher GLP-1 margins will drive higher revenue and profitability growth, and they are expecting a 33, 42 and a 60% CAGR in terms of their revenue, EBITDA and adjusted PAT respectively over FY25 to 28. So a positive recommendation coming in on OneSource.
Okay, thank you very much for that. I think the stock of the day could be Gabriel. At least in pre-opening, Gabriel is up close to about 20%. Let's get that up. Remember, Hormuz was just telling us earlier they plan to merge Anand Group's auto and related business with itself. So to transform the company, expand its domestic dominance, global presence, simplify the group structure, and also answer shareholder concerns on product diversification and M&A strategy. That's the rationale given for the entire merger
Rima, very
exercise.
quickly, the stock is up 18% the last 5 days. It's up another 20%. The reason is that the EPS could effectively go up by around 7 rupees on a base of around 15 rupees last year. And that's a big jump in the EPS itself. They're going to be moving from a mono-product suspension company into a diversified one. And return ratios are good as well. So explains why that one's up and about.
Okay, first stick on the Nifty is in the green. It's opened with a gain of about 40 points, 45 points now up. The Nifty is at 25,560 in early trade. One level to track will be yesterday's intraday high, 25,670, but we're still quite far away from that. So it's a quietly positive start to begin trade with. The mid-cap index is up close to about 0.25%. The advanced decline ratio is positive. The Nifty Bank 2 holding up in the green, so that's tracking a minor gain. In terms of the big sectoral gainers, realty is up. Healthcare is up nearly about 0.5%, and the defense sector too is mirroring some strength. The top gainer is Apollo Hospitals following the news flow. So Apollo Hospitals 3.5% up. Paints are higher today, so Asian Paints is a positive tick. So there are only two stocks which have more than a 1% gain. Apollo Hospitals 3.5%, Asian Paints up 1.2%. A couple of the other pharma names are also higher in trade. So at Dr. Reddy's, BEL continues to gain ground, was one of the big movers yesterday. Today it's up another 2.5%. Geo Financials has been showing some strength, and some of the IT names are higher. So HCL Tech and Reliance Industries has opened in the green. The gains are not much. Trend reverses some of yesterday's big moves. Bajaj Auto, on the back of the muted June sales numbers, is subdued 0.5% lower. And some Bajaj Finserv, Axis Bank on the financial side are a tad bit muted. Titan 2 has got a cut of close to about 0.5%.
All right. Well, the stock that's reacting negatively to the price cut is NMDC. The price cut is larger than what the street was working with. So that explains why that one is knocked back. Coromandel International, well, that's coming for some cooling off. Yesterday, it had a big run. We'll keep an eye out on that stock. It's down 2.5%. Let's see whether the dip gets brought into. So that's going to be important. Other couple of stocks, you have Home First Finance. That's down close to around 2.5% in trade as well. Sigachi, yesterday the stock was under pressure. There's a disruption at one of their plants, unfortunately. So that's why, in fact, that one's down close to 6% following up yesterday's cut. What's doing well? Gabriel. This morning I had highlighted the stock of the day could very well beat Gabriel. The few reasons are it is EPS accretive to a large extent with regard to the rejig that they've done. The return ratios of the entity that's going to be merged with it, in fact, is much better. Margin profile is better. And from being a mono-product company, they're going to be a diversified company now. So that's why that one's up and about, following an 18% return in the last 5 sessions, another 20%. So that effectively is up more than 40%. What else is up? Prime Focus, firing away as we speak. And I think Diffusion Engineers, there was a small, small order bin out there, but the street likes it. That one as well, up close to around 5% as we speak. A good start.
A good start. 3 stocks in the green for every stock which is in the red. And right now, the stock of the moment has to be IDFC First Bank. Nimesh has highlighted a brokerage note coming by in a standout brokerage segment, and that stock is up around 4%, piling on the gains that we're seeing this morning. IREDA also came up with a decent update. That stock up around 2% odd. On the way down, a negative brokerage view coming in on Dixon Tech after an up move that we saw yesterday. The stock is giving back some of those gains, so currently lower. And in the broader markets, Raymond, a stock that did extremely well in yesterday's trading session, continues to do well today as well, opens with a 5% gain straight off the bat. Will be very interesting to see where the listing of Raymond's realty business settles today. And we have Gulf Oil Lubricants as well, which continues to do well. So we are seeing that stock up around 4% in the morning as well. Asian Paints, we spoke about how ICICI Securities has reversed their 4-year negative stance on the paint sector. Asian Paints is now up around 1.8%, and Berger Paints is the other one, which is mildly lower, but yesterday towards close had moved to the high point of trade. So where this one goes is something that we will be tracking as well. But the top loser is on account of a brokerage note in the F&O space. Dixon Tech down 2.5%. The top gainer on account of a brokerage note is IDFC First Bank. Everything in the middle, way more green than the number of stocks which are in the red.
Okay, let's take the conversation now to Venugopal Mangat, Chief Investment Officer Equity at HSBC Mutual Fund. He joins in with his thoughts on the markets and the way forward. Thank you very much for joining in. This is Rima here. So let's first start with the, top down. Now, as we enter the second half of the year, what are the big bets that you have at HSBC India? And are you fully invested in equities now?
Good morning, Rima. Thank you for having me on the show. Yes, I think we have always remained almost fully invested. We've never used cash as a strategy. So that's the first point. On a top-down basis, I think the markets are looking, or the economy is looking much better now. The second half of last year, we saw a number of factors turning negative, including the capex from the government side. I mean, this is the first half of financial year 2025. And then, the liquidity pressures that we saw, the regulatory pressures on for lending, especially to unsecured on the unsecured side. All of that actually resulted in the overall economy slowdown, and from there we've actually come a long way. I think the capex numbers are very strong now. Government capex has picked up very strongly. If you look at the March, April, and May numbers as well, I think it shows a very significant pickup. We have seen a complete change in terms of liquidity from a deficit to a surplus, and more to come with the CRR cut. We saw a 50 basis cut in interest rates as well, which is yet to be fully transmitted into the system. So we think the stage is set for better growth on a top-down basis. We currently are working with the 6.5% GDP growth estimate, which is what the RBI has also projected. But my sense is it could surpass that, given all of these factors. And as we go into the second half, hopefully there will be some clarity on the global side as well.
Right. Venugopal, growth is a function of the capex. It's a function of consumption. It's a function of what the government spends are, and it's a function of the exports. On all those four fronts, where do your preference lie? Because you did believe that capex is coming back. Would you play this growth via capex-related stocks, or do you look at the other functions as well?
So I think the last 2 or 3 years, we've seen capex and investments leading the markets and being a big driver of growth for the economy as well. We've for some time believed that consumer discretionary and consumption will pick up. We've not seen numbers yet or data yet to show that or reflecting that. But our sense is that with the tax incentives or the SOPs that have been given in the budget, plus the liquidity, the easing of regulatory regulations on lending, and the transmission of lower interest rates over time, all of that will lead to consumer discretionary picking up towards the second half, meaning the last quarter of this calendar year. We should see the data also coming positive. In the shorter term, I think the investment related sectors, the capex related sectors, will have to take the continue with the run. I think that's the single biggest driver at this point in time, given that consumption will take slightly more time to really pick up from the bottom that has been made. We strongly believe that going into the next financial year, consumption will be a key driver of growth, which is the non-staples part, which is the discretionary consumption piece, whether it is retail, whether it is automobiles, whether it is multiple other sectors, including QSR, etc. It could start with the low-ticket consumption items first, and then over time move into the bigger ticket, automobiles and housing, etc. So that's the way we see the progression in terms of sectors and growth in the economy.
All right. Hi, Mr. Mangad. Good morning and good to see you in. Good to hear your thoughts as well. Everyone's talking about better macro setup. However, the credit growth has been a little bit worrying, right? I mean, you would want better credit growth. Are you worried, or do you believe the triggers are in place and credit growth will recover to say 12-13% by the time we wind up this year? Your take?
Yeah, we were worried earlier. A couple of months ago, we were really worried that, credit growth is weakening. And I think I spoke last time we met, or I was on the channel, I spoke about that. It was quite sluggish at that point in time. But now with the liquidity enhancing measures from the central bank, the surplus liquidity at the moment, the CRR cut announcement, all of this should lead to an easing of pressure on the banking system. Deposit growth has now surpassed credit growth for the first time in multiple months, and in May now. With the CRR cut of 100 basis points, eventually over the next 12 months or more, you could see a significant, injection of money into the system, about 230,000 or 250,000 crores. And that with a multiplier should impact or help the credit growth to pick up. So we believe, by the end of the year, we should clock again a 12 to 13% credit growth in the system.
What about IT? Now, IT is still trailing. It's still about 15% away from its highs, while the Nifty is almost there, just a couple of 100 points, here and there. Now, IT stocks are entering a seasonally strong period. Q1 and Q2 is typically the quarter when growth rates pick up. And incrementally, we haven't seen too much by way of bad news. In fact, CLSA is saying that Infosys is likely to upgrade its guidance. So from 0 to 3%, they could increase it to 1 to 3% or 1 to 4%. Do you think there could be positive triggers for the Indian technology space in Q1? And tactically, there is any opportunity?
So I think the IT sector was impacted, with all the uncertainty, in the global environment, the expectations of U.S. Growth slowing down, U.S. economy growth slowing down, and the tariffs, etc. So that the whole environment turned negative. And even though I think the first quarter is seasonally a good quarter, like you mentioned. The expectation was this year, given this uncertain environment, it would be quite weak. I think the consensus numbers and most analyst expectations are either flat or negative growth on revenue front. But the positive news, I think, is coming from the view is coming from the fact that so far we've not seen demand really fall off the cliff. I think BFSI is still holding up. The more impacted sectors are manufacturing and retail, which probably is slow in terms of decision making and on discretionary spends. But overall, I think the demand has held up till now. So in that sense, we might see some better than expected results, given that the expectations have been quite subdued. Having said that, I think the commentary again will have to be, we'll have to wait and watch and hear the commentary, because going forward with a lag, some of these could really impact growth in the US, and we'll have to take stock, when companies announce results and what their commentary is.
All right, Venugopal, thank you so much for joining in and giving us your view on the markets. In the very near term, you believe that capex will lead the market, and thereafter you see consumer discretionary picking up as well. Still not pretty sanguine on the IT space yet, but you are picking some in the financial. With that, we'll take your leave and wish you a good day. Acme Solar, that's the stock on our radar on the back of their recent order win coming in from the NHPC tender. To discuss that and more other parts of their business in detail, Nikhil Dhingra, who is the CEO of the company, joins us now. Thanks a lot, Nikhil, for joining in. Just, on this NHPC order win, if you could explain to us the details. What is the capex? What is the debt equity? You get 30% via VGF, we understand that. How does the EBITDA accrual work for you? At what rate have you been given this tender?
Right. So this is the first of its kind win for us, wherein we have received this particular bid is coming from Andhra Pradesh, and it's a very unique bid because this is coming directly from the customer and not done by the SECI on its own or NHPC on its own. So it has a direct customer. So the PPA will be resulting in a very early timeline. And the other thing is there is no land acquisition time requirement or a transmission line requirement because this will be housed in the premises of the customer. So in a way, it's a very much less time consuming and much less risky in terms of execution because it does not include a land and transmission line. So in terms of the revenues, it will result in a revenue of around 60-70 crores and a capex of around net of VGF around 500 odd crores. So in terms of ROC, like we mentioned to you, we target a ROC of around 14-15%. So that is the threshold this project will also meet. The good thing is it will be done in a quick timeline of 18 months and it will have a quick PPA because it is coming from the customer and it has a much reduced risk in terms of the execution. It's more like a transmission project than a renewable project.
And at what rate are you likely to, supply this? At what contracted rate? Because your current portfolio is 3.5. You said that the incremental contracts will come at between 3.9 to 4.
So this is actually the metric here is it's a lease kind of a project rather than a tariff kind of a project. So it's a lease rental of let's say 210,000 in one project and 222,000 per megawatt in another project. So you can normalize it through. It will not be equal to that tariff in terms of 3.5 or 3.9, but in terms of the ROC, it is in the similar range. So whatever capital we are employing, it will be resulting in that much ROC. And tariff, you can also say in a similar range for a similar sort of capex.
What is the range, the ROC range?
14 to 15%.
So that means on 60 to 70 crores of capital, you will be making roughly 8 to 10 crores in terms of an ROC.
Like I said, on a 500, we will be making around 70 crores. Yeah.
All right.
So this 500 crore is annual, and you would accrue this over how many years? 70.
So this is one time. 500 crore is one time, and 70 is annual.
Annual, and that would be over how many years?
This is a project of 15 years.
Okay, 15 years. Can you give us some more updates on the kind of order wins or PPAs that you've signed in Q1 and what are the numbers looking like in terms of overall capacity as you would potentially exit FY26?
Yes. So we have a very good quarter one in terms of the PPA. In the last 15 days, we have signed PPAs of 600 megawatts. And of course, one of these PPAs, the project has also commissioned because it was a very unique methodology we followed. We built the plant as a merchant plant, but immediately post-commissioning, we transferred that to the PPA because that PPA required us to offer an operational plant. So it has given us very good realization. So immediate boost to our revenues, and of course, it has resulted in a successful strategy from, let's say, building the plant as a merchant with an existing connectivity and then migrating it to a PPA because that's our core business. In terms of the overall capacity, we are at 2890 megawatt operational right now and 4 gigawatts of bid wins. Out of that 4 gigawatt, we have 2.2 gigawatts of signed PPA now with this 600 megawatt we have signed in the last 15 days. And we have 1.8 gigawatt, which is to be signed PPAs as of now, out of which we are expecting these 600, 700 megawatt to be signed shortly. And of course, the rest of them to be signed in, let's say, a quarter or two.
Okay, got it. Hi, Nikhil. Good morning. Good to see you. And the other big concern for the industry, various industries, has been the rare earth availability. Is that an issue for your business?
Not yet. It is not an issue. See, we are using a lot of capex equipment. Most of it is Indian, but some of it is international. But like we are procuring lithium-ion batteries on a large scale, we have already closed some of the orders for that. So we have already closed purchase orders for most of the key equipments, and we are trying to do merchant battery also, right? Which is in a similar way we did the merchant solar I was just explaining. So our target is that we try and do it as early as possible, because the capex is there are a lot of tailwinds on the capex side in terms of the prices of these commodities. So we are not facing any headwinds on that side as yet, because some of these products, I understand that it is more on the components which require you to manufacture these products, not on the finished goods. So these hindrances are coming on more that, let's say, a motor or some such intermediary which is required to come up with a finished good, not on the finished good itself. So we are buying more of finished goods like the battery itself and not the intermediate goods.
All right, Nikhil, you all run the business. We here from the studios, we analyze various brokerage notes and we read up in the morning. And one notable note came in from Motilal Oswal earlier today. They have gone ahead and they have upgraded your stock, and they're highlighting that from the time you listed, your capacity has moved from around 1.3 gigawatt to around 2.9 gigawatt. And they're complimenting you all on that, because another peer that listed at a similar time didn't go at the same pace. So that's good on you. But a couple of queries here. As you're headed now from this 2.9 to 6.9 gigawatt, they are talking about FY29 being a big year for you. And at peak, they're saying you could do close to around 8,100 crores of EBITDA. Is that possible, going by what all is on the board right now? Things could change, but visibility could be in that direction, 8,100 crores?
It could be. See, our business is not very unpredictable, because we actually are forced to plan in advance, because this is a very capex intensive business. So whatever we win, whatever we clock on the revenue and EBITDA is predicated by what projects we win, what sort of tariffs we win. So the only variable thing for us is the project capex and the project timelines, like with all infrastructure project. The good thing is, in our case, it has been quite predictable, because there have been tailwinds in the capex, and of course, we do most of our execution in-house because of our in-house EPC. So in terms of the revenue and EBITDA, it is totally dependent on what projects we have. And at this point of time, like you noted, we have around 7 gigawatts of overall capacity. And bulk of that capacity involves a combination of solar, wind and battery. And that is why it has...
So Nikhil, in short point, you're saying is at peak 8,100 crores is gettable, right?
So in terms of it is definitely gettable, and of course, as you move further into future, like you are moving into FY29, it is definitely gettable.
Yeah, this is what you had said to us earlier as well, that by FY30 you will look at 7,000 crores and significantly higher than that. Now brokerages have done their back of the envelope calculations, come back with a number, and you believe that number itself is gettable. But that's about the EBITDA. Let's talk about the EPS and your balance sheet, because you currently have over 10,000 crore of debt on your books. I understand that a large part of that is on floating rates. So what would be your debt repayment plan? That's point number one. And secondly, how much would interest rates savings be as rates come down?
So it's a very big plus for us in the last 3 odd months. The interest rates are a big plus for us this year. We have been able to refinance at a very attractive rates of around 8.5% and lower for our operational plants. The rating in terms of the debt load up, it's a 20-year debt for us, and all the debt is linked to a particular project. There is no debt at the holding company. All the debt is on the projects. And our net debt is 7,500 crores, and our EBITDA run rate for this year is likely to be around 2,000 crores. So the debt is broken into two parts. One is for the operational assets and another is for under construction assets. On an under construction assets, you don't have to, there is a moratorium of 6 to 12 months post operation of the project. You don't have to repay that debt till that time. And of course, you have to, then you get around 18 to 20 years post operations to repay that debt. So that's how you repay that. So even in terms of a debt to EBITDA of 4 to 5, right now we are closer to 4 than 5. It is very comfortable because you have to repay it in 20 years. And in terms of the overall maths, typically of an EBITDA around 45 to 50% is your interest. And as we go in the interest rate cycle, we are yet to get benefit of the base rates coming down from all the lenders. Most of our lending around, you can say, 60-70% is floating rate, and 30% as of now is fixed for us in terms of the overall. In this quarter, we did a fixed rate financing from Bank of America and Standard Chartered. So between fixed and floating, there is always a matter of interest rates and what's the key.
Yeah. All right, Nikhil, very quickly, we got that, sorry to come in there, but we've got the broad point. 70 to 80% is floating, 70% approximately is floating. Very quickly, at peak levels, what will your absolute debt look like? Because you've got a big capacity expansion that's coming on stream. And net debt to EBITDA, it'll hover around the 6.5 times. What is it?
Net debt to EBITDA will not cross 5.1 times.
5.1 times. Okay, and peak debt will be what?
Peak debt will be, let's say, when you say 7,000 crore EBITDA, it will not cross 35,000 crores.
All right, take that point. Thank you so much for joining in and giving us your view on the business. The street likes what you're saying. We've seen a smidge higher on the stock price as you joined in and gave us the outlook, the breakdown of the current deal that you've done with NHPC and your future capex plans as well. With that, we'll simply do a short break. But one sector which has been buzzing lately is the paint space. Today, Asian Paints doing extremely well. On the other side of this short break, we will discuss this sector with Manoj Menon, who is the Head of Research and Consumer Analyst at ICICI Securities, joining in our studio. Welcome back. Asian Paints, that's among the top Nifty gainers this morning. We've seen, the paint sector be in focus. So the last many years because of Birla's announcement, but very few days in the last recent days, we also had the JSW Paints deal that came by. This morning, ICICI Securities has upgraded the sector, Asian Paints and Berger Paints, after a 4-year negative stance. So to discuss this and more, the author of the report, Manoj Menon, joins in our studio from ICICI Securities. Manoj, thank you so much for joining in at short notice in our studios. You've reversed your stance after 4 years. I have to ask you this question. Did this reversal come after the announcement on Friday, or were you considering it before that itself?
Mangalam, practically speaking, it's very difficult to actually execute a report in 24 hours or 48 hours, right? So, look, I think we have been actually focusing on a lot of channel checks on this industry, apart from talking to a lot of our network checks, etc. And this view was coming, in our view. So me and my colleague Anirudh Joshi keeps discussing, what the inputs we have been getting. So 3 or 4 things to highlight. One, that in the last 12 months, Birla has already reached a dealer network of about 55,000, which is almost about 60% of what an Asian Paints has got today, right? For a market share which is less than 1/10. So assertion number 1 is that they have done the relatively easier part of getting the dealer. Now you've got to kind of get the throughput in, right? I'm not saying they will not, they will, but the big, let's say, low-hanging fruit is done with. That's point number 1. Point number 2, there has been an industry deceleration over the last 12 months, which we believe is short-lived. In line with the discretionary consumption uptick expected in the next 12 months, we expect paints also to get better. Second aspect is paint industry had a few one-offs also. It's a long conversation, but we have published 2 weeks back on what are those one-offs. Third aspect is paint stocks are currently at about -1 standard deviation. Point number 4, the margins also appears a 15-year low, and I can go on and on, right? I mean, so we have been observing a lot of aspects, and then the timing is just a coincidence, actually.
So why did you not then increase it to buy as against add? Because it's reduce, add, and thereafter it's buy.
That's right.
What will make you buy?
That's right. So simple one in a thesis, which a lot of my colleagues in the morning meeting just asked today, was that Look, I think we are fairly clear that the paint stocks have bottomed out, right? And that's why we got a sort of, let's say, an optimistic view on an ad rating. Now, the difference between an ad and buy is that when I look at the true medium to long term,
yes,
we also have a bit of a concerns about what the exit multiple which the paint companies should command. The reason being that, in the last 5 and 10 years, companies like Indigo Paints, whether it is Astral, whether it is a small, business in paints by Pidilite, and Indigo Paints, and as well as now, the current player, right, Birla, have actually proven that the consensus probably overestimated the entry barriers in paint industry, right? So it's not necessarily such a high entry barrier that is assumed to be 10 or 15 years back. So we are optimistic, but then let me put it this way, the day when which we believe, based on our market checks, that Birla will grow in line with industry growth or a tad or a shade higher, maybe that's a time for to actually go for a, even more optimistic thought process.
How do you expect the market share to now settle between these top 3-4 players, say 2 years, 3 years down the line?
Yeah. Now, if you look at the shares currently, right, Asian is at about 50, Bazaar is around 20, Kansai is around 10, 11. And assume for a minute that JSW Axo goes through, the combine will be similar to Kansai, right? Then there is Indigo at about 3% and also Birla currently about a little more than 3%. We expect Birla Paints to actually to reach about 10% in about 3 years' time, right? Which also means that in the medium term, we also see a scenario in which there is going to be a tough fight for who is going to be the number 3.
Okay.
Right? Between Kansai, Birla Opus, and assuming JSW Axo goes through, right? I mean, the 3 players actually.
Who do you think, though, going by what they have to say, Birla has been very, very confident in what they're saying.
Right.
And also in terms of profitability for Birla, because that's the one who's come in there and disrupted things. How do you see their profitability pan out from here on?
I think the profitability will take some time because there is a case study of Nippon Paints in Tamil Nadu going from almost 0 to 5% market share or even higher. And the day they tried to or attempted it to make it profitable, I really don't think they were able to hold on to the shares, right? That's a risk of any incumbent. I'm sure that, the Birla Opus management I got a lot of respects for, will be smart enough to understand this and appropriately align their profit expectations in the shorter term.
What you said really is, it echoes what a lot of the industry experts have been saying as well. It is easy to get revenue share, not as easy to get the profit share. The other thing that stood out is you said everyone's fighting for the number 3 player. This at a time when Birlas had explicitly said that they are likely to be the number 2 player. We spoke with Bazaar on Friday and they also said that number 1 and number 2 are going to stay no matter what happens. The fight will be among the number 3 players itself. In fact, what we'll do is we'll continue this conversation. Let's hear out what Abhijit Roy had to say to us on Friday as soon as the JSW and AkzoNobel deal was announced.
Changes much, because these 2 players, as you rightly said, have been there in India already. Both JSW and Akzo have been operating in this market. We are more or less aware of their strengths and weaknesses, and we know what they are doing in the marketplace. So it's just a change of hands, possibly a change, in the management style that it is operating in. So from that perspective, there might be some small changes, but overall in the industry, nothing changes much. What does happen is that, there is a consolidation which is happening now. So there are now, 5 players in the industry. The top 2, Asian and Bazaar, remains. The 3rd, 4th and 5th position is up for grabs. And that's where the competition will be intensifying a bit, between Birla, JSW plus Akzo and Kansai.
All right, so that was the management of Bazaar Paint saying that they are not very perturbed by this development. Both these players have been in the market in the past and they are very well versed with their competitive strategies as well. We are discussing the paint space with Manoj Menon. Manoj, you've upgraded your stance to for Asian Paints and Bazaar. You were always positive on Kansai and Aerolac, and you were also one of the few who had coverage on AkzoNobel. With this deal going through, what do you view on AkzoNobel from here on?
So look, we have always viewed Dulux as a brand, having far higher, I would say, awareness versus availability. Or put it simply, it's been a legendary brand, but not necessarily has got the, let's say, the care and investments which probably deserved in the last decade, thanks to probably the scenario which an AkzoNobel NV was going through, right? Not necessarily enabled to invest for growth, etc. And we strongly believe that, with any group, now including JSW, who may have a willingness to invest for growth, right? Dulux can recover quite smartly.
So do you think they have the capital to invest for growth after having paid what they did for this business? And at the same time, one thing that stands out in the paint industry is that everyone has very clean balance sheets. Right. There will be a company that will start off with a fair amount of debt on their books. So how much elbow room will they have to further invest? And JSW Paints has been around for the last 5 or 6 years. They haven't crossed 2,000 crores in sales, right, and they haven't crossed more than 1,200 crores in organic sales. So what makes you confident that they will be able to grow, AkzoNobel the way it deserves to be?
So 3 things actually. If you look at AkzoNobel India currently, right, the current listed entities P&L account, it has got one of the highest gross margins and one of the lowest EBITDA margins. So assertion number 1, that it's a case of corporate overheads and the synergies, actually, or rather, the synergies playing out, right? Second point is actually that Akzo, India used to pay around 3.5% royalty to the parent. After the deal, the brand is going to reside in Indian entity, so that royalty is also a saving, right? Point number 3, we do strongly believe that there is going to be SG&A savings as well. So let's say, while I don't have a number, whether that 15% reported margins will settle at 20, 22, 23, I don't have a published view on it. So there is a scenario that it will be higher than 15, right? Which essentially means that under the new combine, there is going to be enough resources to invest for growth. And now that honestly depends on how much JSW wants to, what are the big game plans, etc., for the paint outlook, what they may have.
Okay, just one quick final question. Now, this target price that you've raised, 2,700 for Asian, and Berger, it's about 650. Is it a valuation reset? Because you said valuations are below standard deviation, or have you materially increased the EPS estimates too?
No, actually, if you ask me, we're not really touched the EPS estimate by, materially. It's still, honestly, if you ask me, next couple of years, if you look at the EPS estimates, rather the CAGR, it's still single digits. Right? Okay. Honestly, not exciting. That's the reason it's not a buy rating, right? It's an add rating. But what we genuinely believe that from -1 standard deviation, we are essentially leaving the worst is behind. Time to actually, let's say, for example, in the last 12 months, 24 months, we would have advised investors saying that, look, you don't have to own Asian or Berger. We are changing that stance to say that at least you should not be underweight.
All right. All right, take that point. Always a pleasure speaking with you, Manoj. Thank you so much for joining in and giving us your view on the sector. We await a longer conversation on the entire consumer space once you return from your Japanese holiday as well. In case you need any tips, Rima was just there, so she'll help you with all the travel plans that you need.
Have a good one.
Have a great. Thanks so much for coming down. Moving on, we've got the management of Titagarh Rail now joining us in the studio. They won an order worth about 430 crore rupees from the Maharashtra Metro Rail Corp. So to talk more about this order win, Umesh Chaudhary, Vice Chairman and Managing Director at Titagarh Rail Systems, is now with us on the show. Umesh, thank you very much for joining in. Always a pleasure to have you. So first, tell us a little bit more about this 430 crore order win. When will the revenue start accruing? What will be the kind of margins? And what would your order book now stand at?
Yeah, good morning, Rima. It's always a pleasure being with you. So thank you very much. It's a significant order win for us because it's a repeat order. It's an extension of the existing contract. So as you are aware, the Pune Metro contract was our first metro contract that we had signed in the country or as a company. So we've delivered the initial trains, and this is an extension order that we have got for 12 more trains that will be used in the existing network. So that makes it more significant. And this is also the aluminium metro, so an extension of the aluminium metro facility that we have created in our facility. The execution will happen within 30 months. So we'll start the first train in 2 years and complete it in 6 months thereafter.
And your order book, what would it stand at now?
So the order book is, if we include our share of the joint ventures or the consortiums that we have got orders in, it comes to about 24,000 crores. And in terms of the number of coaches of metro, we are executing, of course, the Gujarat, the Bangalore through CRRC, and now this one.
All right. Hi, Mr. Chaudhary. Good to see you in, sir. Could you break down the margin profile, between mainline, metros and export contracts, if you could give us a rough sense?
So I would rather break it down in my FRS and PRS segment, which is the freight rail segment and the passenger rail segment, because that's how we account for. And in the freight rail segment, we've always maintained that we are at a margin level of around 12%. In the passenger rail segment, the normalized margin would be around the same, about 11-12%. With the caveat that till we are able to achieve a certain break-even point, if I may, Of course, the margins are slightly lower. The last quarter, we were able to ramp up the margins to about 8-9%. But as soon as we are able to touch the number of production of coaches at about 15 coaches to 20 coaches per month, we should be at about 11-12% of margin. And then the margin enhancement comes when we are able to integrate our propulsion, which will take another maybe 1.5 to 2 years' time. That would hopefully take up our margin to between 14 and 15%.
All right. Mr. Chaudhary, Mangalam here, you've been talking about the execution gap narrowing between PRS and your freight business. If you could give us a sense of your order book composition right now, how much is passenger, how much is freight, and over the next 2 to 3 years, how does your execution breakup, stack up? Because that will be much more margin accretive for the company. That's the story, right?
Absolutely. So as far as the order book is concerned, as I said that, total order book, including our share of joint venture, is about 23,000-24,000 crore. And if I split that, it is half and half. So half of it is direct orders for our company, and half of it is our share of the consortium or joint venture. So that's about 11,000-12,000 crore. And again, if I split it half and half, is the passenger in the freight. As far as the execution is concerned, the freight, we have been executing at about 700-800 wagons per month. And we have now a capacity of doing 1,000 wagons a month. But now the ramp up of execution of the freight will depend on the new order flow, which we are hoping that, the previous tender that was finalized about 3 years ago is now coming to an execution by the end of this financial year. So we are hoping that Q3 or early Q4, we should get new orders from the railways so that the momentum continues. But the real ramp up will happen in the passenger rail segment, where we have started our production of the Gujarat Metro and of the Vande Bharat trains. The first trains of Gujarat Metro will roll out in this quarter, the current quarter, and the Vande Bharat first train will roll out somewhere in the first half of 2026 calendar year. So effectively, if we look at both the order book ramp up and the execution ramp up over the next 12 to 18 months, it is going to be a much more steeper curve in the passenger rail segment.
In a value sense, can you give us a sense currently what proportion of your revenue comes in from freight, how much comes in from passenger? And by the end of this year and by the end of next 2 years, how will that ratio change?
So in passenger, if we look at last year, the revenue was hardly about 10%. Less than 10% was the revenue from passenger, and 90% plus was in freight. In 2 to 3 years' time, we are looking at passenger contributing to anything between 50% or maybe slightly more than 50% of our overall revenue. So that's the ramp up that we are talking about.
Do you have any, since you have such a strong pipeline, so many orders are expected, are you planning to increase your capacity, any brownfield, any greenfield expansion?
Yeah, we are continuously doing that. So we started with a capacity plan in our passenger rail segment. So first is capacity expansion is primarily happening in the passenger side, because freight, we are at about 1,000 wagons a month capacity, and I don't see that we would really require additional capacity considering the overall market size at this point of time. But on the passenger side, we are ramping up our capacity. And as I said, in the next 2 years' time, 2.5 years' time at the most, we'd be at about 70 cars per month, give or take about 70 cars a month, which is a significant capacity. And we are continuously expanding on that. For example, with this aluminium metro contract that we've got, we have also decided to set up. Earlier, we used to buy the flat packs from Europe for making these aluminium coaches. Now we are setting up the entire line of production in Calcutta in our plant in Uttarpara. So all of this expansion is going to help us in streamlining our supply chain and smoothen up execution, and also improve upon margins.
Okay, all right. Very quickly, sir, what about the wheel set business? That's expected to commence in FY27. But on ground, will you still have a problem in the interim?
So wheelset has been a very big problem over the last 6-7 months, and it continued to be a big problem in Q1 of this financial year also, because the rail wheel factory was not able to supply wheel sets on time. But we understand that the wheel production this month onwards, July onwards, should get sorted out, because also the railways have imported some axles and so on and so forth. But coming back to our own joint venture with Ramakrishna Forging for the wheel sets, that is pretty much on track. In FY27, as you said, we would start production. And till that time, of course, we will be dependent upon rail wheel factory and imported wheel sets, as we have been dependent for all these years. And thereafter, we would be in a much better position to get the wheel sets from our own plant.
All right, take that point, Mr. Chaudhary. Thank you so much for joining in. Always a pleasure speaking with you. That is the management of Titagarh Rail Systems. Wheel sets won't be a problem in the next couple of quarters, though they have been a bit of a problem earlier. Going forward, passenger rail execution is something that will drive growth for the company going forward. From 10% turns to 50% of revenue. Thanks a lot, Mr. Chaudhary. Meanwhile, as we are, looking at the clock, moving towards 10 a.m., 3 important listings today. We'll keep an eye out on that. Raymond Realty. The base price has been close to around 1,000 rupees, so 30 seconds to go for that opening. We have Ellen Barry, the gas company, which has an issue price of 400 rupees per share, and Kalpataru, the real estate player, also listing at around 414 rupees as an issue price. So we'll keep an eye out on those listings. Those are visuals coming in from the exchanges.
Okay, moving on. State Bank of India has completed 70 years of its existence today. The bank's rise to the top has been marked by defining moments from the 1991 balance sheet crisis to the challenges faced by the fintech boom. My colleague Lata caught up with C.S. Shetty, the chairman of the bank, for this special conversation. Listen in.
Welcome to a State Bank of India special as the Grand Old Bank celebrates its 70th birthday today. SBI is, of course, mini Indian economy, accounting for 20% of the country's bank credit, 22% of the country's bank deposits. 55 years ago, SBI was born when the Imperial Bank was converted into State Bank of India under the SBI Act. Since then, its deposits have grown, hold your breath, 25,500 times. Its profits in the latest year at 77,561 crores was 52,000 times what it was in 1955. When the nation is in trouble, it looks to SBI. At the height of the balance of payments crisis in 1991, SBI raised $1.6 billion through the India Development Bonds, and it repeated this feat again after a decade during the Pokhran nuclear test in 1998 when India faced sanctions. SBI personnel go on to head many other banks, Yes Bank included, and also staff the RBI and the SBI. There is a deputy governor over there. Most important, SBI has changed with the times. In its 50th year, the bank gave its younger competitor HDFC solid competition in home loans and actually won that competition. Today, with its YONO, it is competing with even fintechs. And on that celebratory note, may I welcome the birthday boy of the day, SBI Chairman, Mr. Challa Srinivasulu Sethi. Mr. Sethi, thank you very much for dropping into our studio on what must be a big day back home at SBI.
Thank you, Lata. It's a great moment for all of us. And I wanted to be in your studio to celebrate this occasion.
We are honored. We are honored.
And, I think the journey of SBI is also synonymous with the journey of India. I think to that extent, it's a great moment to celebrate.
Absolutely, sir.
Thank you.
Actually, when SBI comes, one looks at the future. And so will our viewers. So just give us an idea. What are the immediate targets you have set the bank?
I don't call them targets, but we believe that if you have seen the journey of SBI, it always reimagined its role and stayed relevant.
Yes.
So we believe in SBI that going forward, while we have seen a lot of disruptions in the last 70 years, the disruptions will be much more frequent and much more deeper. So how do you handle these disruptions coming in, particularly in terms of your business models, in terms of the service delivery, in terms of customer protection? I think we all want to focus making SBI ready for another maybe 200 years. Okay. This is what. So the center to this plan is our digital transformation journey. While we have, as you mentioned, the scale and we have the trust of the people, but the scale and trust alone will not make you the best and most preferred bank.
Yes.
So we would like to assure our customers and stakeholders that our investment in technology, digitalization will continue so that the customer engagement with us, which will be much more seamless.
Well, actually, would you say that in the journey, in the 75 years, the government and the regulators' attitude to SBI and state-owned banks has changed? I mean, first, PSU banks, after nationalization, were part of the fisc. There was financial repression. But in 1991, you all were listed. SBI was listed first. And after that, more recently, I mean, the CRR cut, there is no big danger in front of the country. Still, the CRR cut is given so that I think banks have a fair chance against mutual funds. Would you say the attitude is changing to give you all a fair chance?
See, the public sector banks are having a dominant market share.
Yes.
Some of them would have lost the market share, but I think they're all trying to...
Collectively, 60%.
Collectively, we are the dominant players in the industry, which means that any initiative, either by the government of India or by the regulator, cannot be meaningfully taken to the economy and the general public unless there is a wider participation of the public sector banks. I don't think there is any shift in the attitude. But one thing I can definitely tell you that maybe for the last 2-3 decades, or definitely in the current decade, is that we are getting a absolutely commercial banking approach within the public sector banks. And what I call ownership neutral approach towards, serving the customers. And that is getting reflected, obviously. The CRR cut is not meant for only...
You're getting a level playing field.
Absolutely.
Okay.
Absolutely.
That has been the tone of the Reserve Bank. But I think the banking sector, that is public sector and private sector, have got a better deal this year with liquidity being thrown in and the CRR cut. How are you looking at, this combo affecting your credit growth? I believe the finance minister also met you all. Do you think this year the credit growth will be much better? Last year, I think we are finishing at 9-10%, FY25. What is your sense of this?
Since our silent period started now, I can't...
I'm asking you about the sector.
We can't talk only about SBI, but I think in general, what are the preconditions for any economic growth? I think those things are being ensured fairly well in terms of, ensuring that the system liquidity is adequate. And as you mentioned, CRR cut will add further liquidity to the system. Apart from the benefit of protecting the margins, which cost of funds are reduced. The other thing is that the upfronting the rate cut, these are all indications, signaling obviously is towards ensuring that the growth is on the higher pedal. I think this is
higher priority.
Higher priority. And the government of India's initiative of putting some extra money in the hands of the people to encourage the consumption by reducing the rate of taxation.
No, you give me numbers for the banking sector, sir. I know I don't want to corner you on your silent period issue.
The banks will definitely come back to the credit growth.
So you think we could do 13, 14? I don't know how well you remember the 2002 to 2004 period. Reserve Bank had cut rates from 15 to 8%. After the Pokhran, we had to raise our rates, and then Asian crisis. We brought it down dramatically. But credit growth didn't pick up for another 2 years. It remained at 10%. And then only in 2005, we see this 25% jump in. Credit, when it slows, takes time to grow.
Absolutely.
But now do you think it can be faster?
I think it is. Stage is set, in my view, maybe a couple of quarters from here. One is the corporate credit has been a challenge for the last few quarters. It is mainly because they're all sitting on a
retained profit,
reasonable cash flow, cash availability to them. And I believe that a lot of brownfield expansion, which is undertaken by them, is being taken by their own cash. And that is also getting reflected. If you see the SME growth, we are all witnessing good growth in SME, which means that SMEs are basically B2B businesses, right? If the corporates are not giving the orders, they're not going to perform better. So which shows that the corporates are spending and also giving the orders to SMEs. But the next inflection point for the capital expenditure would have to come. One is most of them are operating at 75 to 76% capacity utilization. and a sustained consumer sentiment and consumption growth. It is not that it's not there, but I think people would like to see the sustained level of that.
You're saying that capex has not picked up, but it is looking all set to pick up.
All set to.
Okay. What's your sense about margins? Again, for the sector, I'm not cornering you, because you're going to get this, the rate cut will take away your margins, but the CRR cut will give you back margins, and it comes with a multiplier. Yeah. Every subsequent deposit will give you some gain. So will you come back to your FY25 margins in 4 quarters, 6, or for the banking sector? Does it take 4, 6 quarters to come back?
Most of the banks have indicated that it will be a kind of U curve for the NIMs that you will have. I mean, there is no rocket science in that.
Yes.
There's a lag of deposits getting repriced, whereas...
How much? Is it 2 quarters lag, 4 quarters?
No, I think we'll have to look at Q4 end state.
Okay.
And most of us probably would be sticking to our margins at the Q4 end state. That is what I can tell you now.
Okay. I wanted to come to the, the SBI history itself. As you cast back 70 years, I guess you would have been at least for 1/3 of that.
More than that.
Yeah, more than that. Okay, 35.
37.
Half the history you have seen. Any one memory or any few things that absolutely stand out?
If I have to, of course, there are many things.
Yes.
SBI, there's no dull moment in SBI that I keep telling that. But if 2 things which we have to see from an institutional perspective, not from individual perspective, I think the liberalization has completely given a new paradigm for SBI. See, till that time, you're a dominant player. We still are a dominant player.
The deposit and lending rates were set by RBI.
Absolutely. And then you have new age players. Post-liberalization, you have new private
bank licenses.
And many things which have happened. My view, I think the watershed moment for banking as a whole and SBI in particular has been the post-90s.
Okay.
It has given both opportunities and risks. Risks of, we have completely had to remodel our risk management. That the global risk and your own internal economical risk, which needed to be relooked at, while the opportunities were aplenty.
Okay.
So I think that is one. And the second important element, I think, for the country, globally, I think unprecedented COVID was another thing what we really learned many things. It was an extreme business continuity process ensuring, right? You can't have a better testing of your BCB preparedness.
That's right.
I'm very proud that SBI has come out extremely well in terms of our commitment to customers.
Oh yes, not just that. Look at the quality of the balance sheet. In spite of going through a period when people could not go to work.
Absolutely.
I guess you have a historic low in terms of net NPAs now, 0.5% or less than that.
Less than that.
That's quite a record. But since you say 1991, you all got listed in 1990, right? Now, will you use this 70th year to mark some listings? You already have 2 babies listed. Will more come?
No, the babies will, I think, have to still grow up. It will take some time.
Okay. The market is kind. You're not likely to use
not it.
All-time highs, very close. And what about SBI itself? You're not looking to use the market's good mood?
We did take the enabling resolution for QIP
that is why I'm
of 25,000 crores. I think while the timing is not decided, we have time up to March 26 to launch this QIP.
Okay. So, again, let me ask you to, cast your mind back. What would you say were the most challenging moments for SBI? When did you all spend sleepless nights?
So, I don't think we spent sleepless nights because of, I think, crisis management inherent to us. Yes, I do agree. COVID was difficult, not because of any business environment. We had to protect the customers who are visiting our branches and, more importantly, protect our staff. I think if you really ask me from a management perspective, that was the most traumatic period which we all have gone through.
Okay.
And probably none of us have taken a day off except when we ourselves got infected by COVID.
And you can catch excerpts of this conversation all day today on CNBC TV18. All right, let's quickly just get a handle on the rates on the new listings. So the first one is Kalpataru. The issue price was 414. And I think it's had a fairly flattish, 8% up now on Kalpataru. So that's higher. The other one is Globe Civil Projects, where the issue price was 71. So we'll get that. That's up 24%. And I think Ellenberry Industrial Gases, which is a competitor in a way to Lin, that's had a very strong listing, 33% up on Ellenberry. And Raymond Realty, which is the real estate arm spun off from the Raymond Group. This would be the third listed entity from the Raymond Group, and that's open with a gain of about 5%. The base price was 1,000 rupees. Compared to that, it's an uptick of nearly about 5%. So good day, good start for all the four companies which have made their debut on Dalal Street today. For the markets per se, also very, very quiet, just holding up in the green for the Nifty and the Sensex by a smidge. I'll get into a break. On the other side, we'll invite Mitesh Thakkar back again on the show. Welcome back. Mitesh is now with us for a few trading ideas. 1 hour done since we started trade. Mitesh, what would you have for us?
Yeah. Well, I think the index hasn't been doing much, but the action is happening in the individual stocks. And amongst them, the one which I like, I have a buy on Dabur. Marico and Dabur both have rallied. Dabur has, been in consolidation. So buy here with the stop at about 482. Look for targets of around 500 plus. And the other one which I like is DMart, which has been a recommendation earlier as well. Now can be bought with a stop below 44.30 for targets of 45.60.
Got that. Though the mid-cap index has snapped that 7-day winning streak today, so it's mildly lower, 66 points down. It could turn any time, but the mid-cap index has a shade of red going for itself. Mitesh, in the frontline pack, it's Apollo Hospitals, and we'll get to Ekta to talk more about this reorganization. But Apollo Hospitals, technically, it's a fresh high.
Yeah. So, Apollo Hospital has broken out of a triangular consolidation a few days back and it's showing continuation. Today, there was a gap up and then we saw the stock kind of retreat from the intraday highs, which is slightly overbought. But if you get, levels close to about 7,400, I think that will be an excellent entry point. Eventually, I think the stock will top 7,800, 7,850 levels.
Thank you very much for that. Let's get to the stock of the day, and that's Gabriel India. The stock has a gain of close to about, it opens straight away, gap up close to about 20%, and now we should get that up for you on your screen. Hormus is now joining, still locked in an upper circuit. Hormus joins in with a fine print on this transaction that they're doing.
Upper circuit for Gabriel India. We spoke about this in the morning, that the reorganization that they are planning to simplify their group structure. Now, in their investor presentation, they mentioned that as part of this consolidation that they are doing of the Anand Group's auto and related businesses with itself, it will be done through a multi-step process. Now, first up, they will be merging the company called Ankemco into Asia Investments Private Limited, AIPA, and then the automotive division of the AIPA, which will include Ankemco and others, including Dana Anand, Henkel Anand, and ACYM, will first be demerged from AIPA and then be merged into Gabriel India. Now, and the other non-auto investments will remain with AIPA. Now, as part of this deal, Gabriel is going to offer 1158 shares for every 1,000 shares held in AIPA, and this deal is being done at an FY25 EV to EBITDA multiple of 8 times. Now, post this transaction, of course, subject to shareholder approval, regulatory approvals, and once that happens, the deal will take effect in the next 10 to 12 months is what Gabriel has said. And once that happens, the promoter shareholding will increase to 63.5% from currently 55%. Now, as part of their rationale, they cited that they plan on doing doing this to transform the company, to increase its domestic and global presence, to simplify the group structure, and of course answer shareholder concerns on their product diversification and their M&A strategy, saying that they're creating value without any additional leverage or cash outgo, is what Gabriel has said. Now, the street had a whiff of it because the stock was up 20% in the last 5 trading sessions itself, and post the news being out, the stock is up another 20% in today's session.
Thank you very much for that. And let's now get chatting about Apollo Hospitals and their plans to list the pharmacy and the digital health business. Ekta is here. Ekta Street is clearly excited with this prospect.
Yes, absolutely. Well, Apollo Hospitals will be demerging its pharmacy, digital health and pharma distribution business to a new listed entity, which is for ease of understanding, named New Company. Now, the transaction involves 3 steps: demerger of the omni-channel pharmacy and digital health business, which is Apollo 24/7, amalgamation of Apollo Health Co., which contains Apollo 24/7 with the new company, and merger of K-Med, which is basically their pharma distribution business, into NewCo. Now, Apollo Hospital shareholders will receive 195 shares of the new company for every 100 shares of Apollo Hospitals held. The new company is expected to be listed within 18 to 21 months, and Apollo Hospitals will retain a 15% stake. Components in the new company are Apollo 24/7, Apollo Pharmacies, K-Med, and Apollo Hospitals Telehealth Unit. The projected revenue, 16,300 crores in FY25, and targeting 25,000 crores by FY27 with a 7% EBITDA margin. The structure mainly removes the holding company discount. That's the reason you're seeing the stock react positively. Morgan Stanley has written on it. They have an overweight rating, target price 8,058 rupees. The new company has aggressive revenue and EBITDA targets. If it meets that, it would generate shareholder value according to them. Citi has a buy. They say the development is positive for Apollo shares. They expect the discount to narrow with separate listing and a lean business structure.
Thank you very much for that. The mid-cap index is down about 85 points, snapping that 7-day winning streak. NMDC on the back of the price cut is down close to about 3%. It's breached the 200-day moving average, and Dixon Tech too, on the back of that downbeat note from a brokerage, has lost more than 3%. Get into a break. On the other side, we'll get you updates from the commodity and currency space with Manisha. Welcome back. Let's talk about currencies now. Manisha is now joining in. Manisha.
Thank you for that, Rima. Well, the dollar index is on screen because that really has been a conversation as well, right? 11% of a decline in the first half of 2025 has been clocked in already. Now, this is the biggest half-yearly decline that we've seen since 1973. So this is the first time in 50 years that the dollar index has seen such a decline in 6 months period. This also is the worst first half decline in a year that we've seen since 1991. So clearly, dollar index making a lot of records there, and all for wrong reasons. Well, to begin with, it is the dovish US Fed outlook that the markets have seen pressure come in from. It has been about Trump's proposal on tax and spending bill, which hasn't gone so well with the markets there. And then apart from that, the European institutional investors and pen funds, reserves, all of them really seem to be selling dollar treasuries and buying into their own and other currencies, even gold for that matter, and that hasn't done dollar any favor. When you look at the Chinese markets as well, they have stepped up the sale of US treasuries. So every central bank in that sense, especially in the Asian and the European market, seems to be selling dollar as the treasury and dollar treasury bills as well. That is the reason you've seen that decline coming in. The other factor really is about the US fiscal trajectory. When you look at those numbers, then the public deficit has exceeded 6.8% of GDP. And when you look at the federal debt, well, that is nearly 120% of GDP, standing at a tall $36 trillion there. And even when you look at 2025, the US isn't really servicing that debt. It is rolling it forward, and that doesn't augur well. Is the reason you've seen CFTC data also tell you that the speculative long positions when it comes to US dollar also are net shorts, the highest in 4 years. So nobody's buying US dollar or the dollar index, and that's clearly seen in case of prices there. So even as the dollar index is trading at around 4-year lows, and we've seen 11% decline in that, this is what the other currencies are done. These are the major currencies. The euro is trading at a 4-year highs, Singapore dollar at a 10-year highs, Swiss franc at 10.5-year highs. You have the pound sterling trading at a 3-year highs as well. And then you have various of these Asian currencies where you have the Korean won 37-week highs, 6-month highs for the yuan, 2-week highs for the Japanese yen, 8-month highs for the New Zealand dollar as well. So we've seen stronger gains come in for many of these currencies there. When you look at the moves itself, well, dollar index, as I said, is down by 11%. But in contrary to that, you're looking at euro up by 13% in the first half versus the US dollar. The pound sterling has gained up by 9.5% versus the US dollar in the first half of this year itself. And then you have the high-yielding currencies, the commodity currencies. And as you can see, it has been a 6, 9 and a 13% of a gain that Swiss franc also has put out. So we've seen very, very strong gains come in for this one. The Chinese yuan is gained up by 2.5%, and the best of the gains, a 10-year high for Singapore dollar, comes in with a back of 7% of gains for this year until now. The Japanese yen is up by 9% as well. So clearly, anywhere between 3 to 13% of gains is what we've seen in many of these currencies. Korean won is up by 8%. You have Taiwanese dollar gaining up 11%. It's only the Indian rupee, while we've seen a huge volatile moves and a big swing move come in for the Indian rupee for the first half. But we seem to be closing the first half only with very, very minor declines there. So a very flat Indian rupee, but that is relative to a very strong other Asian currencies that we've seen versus the US dollar till time.
Thank you very much for that. And that brings us to a close in this edition of Bazaar. Thank you very much for watching. Stay tuned. Chartbusters is up next.